Yo, what is up? Hello,
Hello.
welcome.
How are we doing?
Uh, Doing pretty good. The kind of saw, that today we're gonna have that pop following the BOJ last night, but fundamental things haven't changed in the US, so everything kind of hit the thesis, at least for me. I don't know about anyone else on the call, but yeah, doing pretty good.
Well, other than misclicking a trade today and selecting
Oh,
both the wrong strike and the wrong price,
oh no.
I paid twice the fair value for a vertical in HubSpot, and that was pretty dumb. You know what can I say? Just I have really bad eyes, and I've got to get a bigger setup. Like it's becoming a problem again where I can't see.
Are you using a laptop screen?
No, I got a dual monitor set up, but like
Ah,
even
okay.
then, even then it's pretty bad.
So you're like you want more screen real estate, basically.
And just bigger. Like I just need to be bigger. You know, so
Right.
I've got two 27-inch screens. So it's not like that small, but um, when you're visually impaired, it's still pretty small. So
Mm. I I actually for this new setup at home, I've migrated to 32-inch screen.
yeah,
Um, there are more and more especially the new products. There's more and more people doing it, like Samsung and LG, because they make the panel. So now they cut more in 32 inches rather than 27.
yeah,
So that's why all the new ones are like 32-inch, and they have been really good. Like the experience for me is pretty good. I mean, like sometimes you have these Windows scaling issues, right? With large high definition like 4K large screens, but yeah, this time like upgraded, everything's fine. So I think you can pick up some really nice deals during the holiday season this year.
yeah. I'm probably gonna do it like now. You know, just for the price I. Someone has a nice steak dinner on me, so for the price I paid them for that vertical, then I could have had better screens. You know, it's like
Right, right. 32 is definitely the way to go. Like, get the 4K, because it'll make it sharper. Like 32, if you do like even 1440p, it's too low. Like, if your eyes are adjusted to iPhones, then 4K is a must.
yeah, 100%.
Mm. Um, yeah. So, what was your take on the BLJ last night? That came out of nowhere. Like suddenly halfway through the Asia session, that kind
I
of just
mean,
hit the.
I would just like to insist
Mhm.
it's not a dovish pivot or market like overreacting.
Well, right. The thing I posted in the chat, it's not from me, it's a headline.
Yeah, because
I'm with you.
people only read the headlines.
Yeah,
No
they
one
like
actually like read the report
I
or like
actually read
actually
the
listen
report.
to. I mean, no
I mean,
one
I
actually
couldn't
like
understand
listen to the
Japanese.
speech.
I mean, I
Yeah, I
read
mean,
the
like,
English version of the transcript from BOJ
no,
website. It's
I
super
mean,
balanced.
whatever. But anyway, the price happens, so that's it.
Hmm.
I think that doesn't really change anything. Like,
Yeah, I don't think it changes much. I mean, he's just saying that he's gonna hike later as opposed to now. You know, so
Hmm.
market will
Hmm.
price it in.
the audience is like it's like financial lay people. And he's not like making this speech towards some traders or like someone in the bank. It's just
And it's
like
just one
local
line, right?
business,
Yeah,
just like local business
Hmm.
leaders. He's just like explaining like how they're implementing their monetary policy. I mean, especially with such a unprecedented like market like volatility. I mean, it's just how they're doing things, but like the virtuous cycle between like the wage and the inflation is still there.
Hmm.
Are okay if like slightly higher inflation on the condition that wage increase in a similar pace.
Uh-huh.
I mean, they're not kind of like losing focus on inflation. It's just still like, I mean, they're just like taking a pause because there's like rainy weather, but when the weather is like sunny, then they're just like keep
Mm-hmm.
walking towards their goal. I mean, there's really nothing changing. It just probably like due to, I mean, I'm not sure like how liquid like the Tokyo hours is.
It's
Um,
not super liquid.
but yeah, I mean, just probably some like algorithmic like knee-jerk reaction after reading the headlines. Okay, like one sentence, it's we're gonna like sell some yen, and when like the liquidity is not there, then boom, like we have like 3 points of. I mean, yeah, I mean like there are probably like one or two like uh experts on Japan markets that are actually like sharing their views on Twitter,
Uh-huh.
and I tend to kind of like, yeah, I mean I tend to like value more about their opinion, like there are like so many frauds on Twitter
Mm-hmm.
that claims to be like a Japan expert, but they actually are not. And yeah, but like the two experts I'm following, like both are saying BOJ did not cave. Everything's just still going. They're just explaining how they're implementing monetary policy. This is like more like an implementation detail when there's like high volatility in the capital market or like financial market. We're just gonna like pause a little while and observe, but doesn't mean like we lost focus on the inflation outlook or like the growth outlook. Everything's still like, as long as they are observing the virtuous cycle of the wage and inflation, I mean, that is still going, and they're just gonna hike rates. Expectation is like 0.5%, like 50 bips by the end of the year. Yeah, so we'll probably like see more hikes after like this episode of whatever, the carry on wine or whatever, like it's over. I mean, they're gonna just like keep doing their thing. I mean, yeah, just right now wait till like the volatility like just calm down a little bit, and they'll probably just like gonna do just keep their path. Nothing has
Right.
changed. Not a dovish pivot. That's hawkish. I mean, that's. I don't think that's kind of like the tone they're kind of like trying to convey, and that's not. It's just not it. So yeah, we'll just like wait out. I mean, obviously, like the and just yen, just dollar yen went from like 144 to 147 after the analyst meeting the speech.
Mm-hmm.
But yeah, I mean, well, I mean, just like in the landscape of yen, this is, I think this is just normal.
Well, I mean, I was the Honda CEO is definitely on your side. So they released the earning, and tons of questions have been asked on the FX side from the sell side, and the CEO's like we were like having a heated debate on whether we want to change our dollar yen interest rate currency rate forecast on this earnings call, and they decided not to do it because we want to be prudent. Um, Next 2 quarters average is 145. 2 quarters after that is 135. It is like what they are putting into their model. So if there's a surprise to the upside, then for at least Honda, they won't be impacted as much. Like the other ones like Denso, and the other company I mentioned earlier on, I think Toyota, they were on the other side of the spectrum. So yeah, it's an interesting time to see how you know during this extremely volatile market, some corporate management are being very prudent and some just like extrapolating the line. So yeah, I mean, I agree. It's a balanced view
What
from
happened
BOJ.
like what happened like in the last hours of the U.S. markets? I mean, I took a nap because I know like today there's like relatively light like the economic release, but I mean before I took the nap it's like 53.21, and when I woke up it's like 52.10. I mean, what happened? I mean, I'm checking the news feed. I mean, I don't see a lot of things.
Hopefully, it's not your nap. It's like Barnaby's absence.
I mean, I'm not just like
Yeah.
not seeing like relative like.
Wait, James, it was not you triggering that option trade, right? Otherwise, we'll have some fast finger
Yeah,
headlines.
it was just my absurd mistake, and
Just
wonderful
move the
print,
market.
wonderful print. I mean, I guess the other good news is that I also fat fingered I was 1/10 my normal size, so I made a really small error, but it was just stupid, you know. And it's not the first time. Like I've my eyes are costing me money all the time, and they cost me money in poker and stuff too. Like I get where I can't see the difference between clubs and spades, that kind of thing.
Oh yeah, you
And
gotta
Do,
buy
do you
those
do you
buy
have
those
like
cards with
anything?
bigger ones, bigger logos.
Do you have like anything? I mean, is this kind of like a like something of like a prescription lens can solve, or is like something else?
I mean, I've got prescription lenses in. I just have really bad eyes, you know. So
Oh, I see.
like the problem is that my glasses, the prescription's only stable like in the dead center at the focal point,
Oh,
and
okay.
then I see a little better with contacts, which is why I have them in now. I want to put them in, but they drift and move all the time. So as I blink, the lenses are so big that they're toric, they're always swiveling. So it's a pain. There's nothing to do about it. I'm not a candidate for any kind of surgery or anything. So it's just hopefully they hold up until they get the bionic eyes of the Teleoxu from Dune, and I'll be the first to have them probably. Um,
I think going back to that question, wasn't that caused by the 10-year auction today that we had a
Oh, I see. I mean, yeah, it's like how much bits did it tail? I mean, I remember it's like around 4 bits.
6? I, I might be wrong, but don't quote me
No,
on
no,
that
I'm
one.
I'm I'm gonna check because I did see like yeah, I
The
mean
10-year went up to like 3.9.
yeah,
I
it's
remember.
almost like 4 bits. It's tailed like
Okay.
oh, it's not almost four. It's like
Uh,
three bits, three
three?
point one bits. Okay, but anyway, yeah, I mean this is like tail. What's the bit to cover? Yeah, I mean I'm not sure like why this like one issue yield is like this data is kind of like elusive. Is it like easy to like get the one issue yield on Bloomberg? I mean I'm having trouble to retrieve data from Definitive.
Wait, one sec. What are you looking for, by the way?
When issue yield. So like before the auction, there will be
Okay.
like some trading. I mean like the pre-auction trading. I think there's like soon to be auctioned bonds,
Uh,
and so like at the time of the auction or like right before the auction, there will be like a yield. It's kind of like one issue yield, and you want to compare like that pre-trading yield to like the actual high yield of the auction, and like how much did it like tail, how much did it like through. Okay, yeah, I think Bloomberg has like a 10-year tail through indicator. I'm not sure if like that's something, but yeah,
wait, one sec. 0.031?
yeah. Yeah, I mean, if like they have the data, that's pretty nice.
I
I
think
gotta
it's,
like I gotta consult the
uh,
Infinitive side guys to
yeah, I think it's 0.031.
yeah, it's like 3.1 bits. I mean,
Auction,
I
high
get
yield,
these.
and the one issue yield difference. Yeah.
I got the I have to get the data from like my Twitter feed. I mean, there's like
Right.
some
So
people like are 10-year bits cover.
I'm not like super expert in the rates market, but like, what does that suggest?
They're just like if it's tailing, then that means there's like poor demand. Yeah,
Poor
the bid
demand.
to cover
Okay.
bid to cover ratio is also like on the low side, 2.32. Yeah, that means just, I mean, at least for this auction, people are not interested in buying. Um, yeah, I mean, but a good auction will be like a high bid to cover ratio, and then you need to like have through.
Wait, does that mean there's less expectation for rate cuts?
I don't think that's about like the rate cuts. I mean, this is like 10-year. I
Yeah.
just think
So
if there's like a very low demand on this like longer duration bond, then yeah, it's just like people like right now are not interested in buying like 10-year. I think people are more interested in buying 2-year, defending a possible recession scenario. I mean, this is like also evident in the curve. I think 210s is closed at like -2 today. It's like -12 yesterday. It's like up 10 bips. I mean, the 210s are close to on inverts right now. So this like bull steepening is still going on. Um, just like bull steepening. I mean, my dashboard kind of like resets. I have to check 10
and
year,
what
10 year, 10-year yield. No, I don't think today is like a. I mean, it's steepened, but it's probably not a bull steepening.
and do you have like a view on the jobless claim tomorrow?
Currently I don't have. I mean, there will be like multiple like factors. I mean, you guys already like talked like ad nauseum about like the retooling, um, like the hurricane barrel. Some were like the hot weather. I think there's like also like a Minnesota like yeah, there's like a unemployment like benefit change in Minnesota that may like influence the final like jobless claim number. But yeah, we'll have to see tomorrow. I mean, I've seen like some estimates on Twitter that is like 240K. We'll
Yeah,
see.
240 is like
What's
the
what's
median.
this? Yeah. So
What was your question?
no, I don't really have a question. I was just
Oh,
thinking.
okay.
I mean, I should have like yeah, I should have like the consensus number here as well. I'm just
So
seeing
this is
if
242. Oh wait, sorry. 240 actually.
initial max. Okay. Yeah, 240.5 is unrefinitive.
Yeah. The median
Continue
here is 240 averaged.
continuous like jobless claim is 1.872 million. Yeah, I mean we'll just have to see tomorrow. I mean there's obviously multiple factors that can play, but yeah, I mean it's
Cool.
just like
Okay.
we'll have to see tomorrow.
Okay. Um,
But I mean like overall there's like still like no significant like uh development in other industries. Do you see like anything like in auto industry? Like is there like
mm,
any new layoff announced? I
there's
don't
no
think so.
there's no more incremental ones from my end. I'm keeping an eye out as well. So
So yeah, I mean it's
yeah.
just tomorrow. I mean, I think one thing that caught my eye today is like yeah, crude oil has like up $2. I mean of course like the EIA has shown like a draw higher than expected draw for the crude. I mean the gasoline and like the diesel, like those are kind of like the inventory is up. Um, I mean we're already like close to like the end of the traveling season, so I mean this is kind of like I mean
I
at
thought
least like
crude
the
was up
build.
because of the Russia thing.
Yeah, the Russia. Yeah, I mean there's like also like several development in the geopolitical front. So like one thing is like the Egyptian airline has announced like an extra announcement about like a no-fly zone above Tehran. So not sure like what's happening over like the Iran-Israel side. I mean my prior is still like it's just like Iran is doing like such a bad job like in anti-espionage and like there's just too many like I don't know like imposters maybe like but anyway like it just feels like they're kind of like making them like seem like they're going to attack but like they're still not they still haven't done the attack so I'm not sure like how long they're gonna kind of like just do like this like flexing or like but like without actually making move but I
Well,
mean
last
it's a,
time it took a week, right?
yeah I mean like the I think the intelligence or whatever. I mean, during the weekend, it's they said that the attack is gonna come on Monday, but right now there's still nothing. So probably we need to wait for a little while. And then of course there's like the Ukrainian incursion towards the Kursk region. I think they're kind of like going into like Russian territory, and I think Russian are kind of like already deploying like extra force to like counter the attack. But anyway, the oil, I mean, with like the draw in the EIA, I mean, it's like the oil has like upped quite a bit today. So yeah, I mean, that's probably, yeah, overall, just like some escalation in the geopolitical front, a poor 10-year auction, and like 210s like steepen. It's almost like close to uninvert. And then after that, it's just like equities um falling off. But yeah, I think all eyes are probably on tomorrow's jobless claims, where we want to see like multiple factors. I don't know if like you were there like a few minutes ago, but I've seen like four factors mentioned. So there's like Hurricane Barrel, and there's like some hot weather um, in other places, and there's like the machine retooling. There's also like some changes in like Minnesota policy again regarding the jobless claims. I mean, unemployment benefits. I mean these are like the four factors I've came across when I'm like view all the news and like the sell material. So yeah, I mean tomorrow consensus like 240K. If we get like a consistent like uh upside surprise, then we got like more evidence that like the labor market's like slowing more than we thought before. So yeah, I think that's probably it because today's like relatively just light. Yeah, I think the mortgage rate is down quite a bit as well. It's from like 6.82 to 6.55. So I mean that's like 30 bips down from the mortgage rate. I think that's kind of like a surprise because I think for the previous weeks the number was quite stable at like 6.80, but today it's like 6.55. So yeah, I mean that's probably it. I mean, did you like hear like the BOJ discussion, or you are not here?
I caught a little bit of that. I had to send out a couple of emails though. So I missed part of
Yeah.
that. But
Oh yeah, but yeah, I mean it's just like the deputy governor Uchida talking to like a local business leaders and like Hakodate. I think that's probably like the place. So like no, the audience is not like traders, banks, just like local business. And I think basically Uchida is just explaining how they're implementing their monetary policy. So like when there's like elevated volatility in the financial and capital markets, they're just gonna pause a while. But like the virtuous cycle of between like wage and inflation, they are getting they're still like confident like this is happening. And they also did like a survey where they like asked like firms and households. So do you prefer inflation? And I mean, people just say no. But if like your wage is increasing like to a similar extent with like the moderate inflation, would you be okay with that? And I think the response was like 70% people are okay if like the inflation is going up on condition that their wage is also going up. So yeah, so overall, I think BOJ is still like, I mean, a lot of people are saying BOJ caved, but I don't think that's the case. Uh, it's just like this temporary market like turmoil made them kind of like, it's like you were like hiking on the trail and suddenly when it rained, then you're gonna like stop for a while, and when it becomes sunny, you just keep walking. I think that's what happened right here. And yeah, I mean, I think that's basically like my read, but we'll see like what happens like in the next week. But overall, like today is just like I think probably like the bigger news is just like the poor 10-year auction. Like it tails 3.1 bips. The to cover ratio is like 2.32. I mean, it's kind of like a bad auction. So like at least like for this for this auction, like people are right now are not interested in buying this like duration. I mean, it's like the 210s have like went to like -2, so it's almost like close to uninvert. It's like -10 yesterday, so 12 actually. So it's like it's steepened by 10 bips. Yeah, overall we have like steepening. But I think today is more like a bear steepening because I think the yield went up. So yeah, and that kind of like I'm not sure like how much is like correlated to the downside equity move, but yeah, I think that's probably like the interesting development in the bond auction side. So yeah, overall, I think that's just like what I have for today. Yeah.
Nice. No, that's super helpful. I think one of the things just to kind of keep in mind when you're thinking about, policy rates is that there's like the underlying structure, right? Which is we know that in the United States, the policy rate is going to move lower. We know that in Japan, the policy rate is going to be neutral or move higher. So the rate differential spread is narrowing. That's one key facet. That's like the first thing. How long does it take for firms to reposition when the, say, direction of that spread flips? That could take some time. What are the economic consequences of a flipped interest rate regime? Well, in an environment where the Japanese, if the US economy is cooling, okay, and the Japanese economy is stable, okay, then that tells you that, say consumption of yen, like the pattern of what people have forecasted for the consumption of yen versus what people have forecasted for the consumption of the dollar, like what side is going to get revised lower? It's the dollar side. So, the exchange rate acts as like a stabilizing mechanism that responds to economic performance differentials and interest rate differentials. And so as long as there's some, like the whole thing is that Japan has been in a secular long-term growth funk and it's not likely that it's going to that it's surprising that it's actually outperforming recently. But the argument that's happening with, the Japanese situation is the recent blip the start of a shift in that? Like has Japan's fundamentals caught up to the financial markets? Or is this just a simple blip and that a year from now or 2 years from now, we'll go back to, ZERP for Japanese policy? And it's hard to tell right now, right? Where it's like early in the
Yeah,
process.
yeah,
But
but yeah,
the
if
key thing is that this should change. Like the risk management is there, which is that you're in an environment that's now uncertain, and so you need to kind of shift that regime, especially. And the thing that's more important here is that it is like less about Japan and it's way more about US higher for longer thesis. So that shift is what's driving the repricing much more than a BOJ shift. The thing is that we're first seeing this dislocation in Japan just because that's where a lot of the leverage is, right? So that's why we're seeing it in Japan. But it's really an American story and then how that story is impacting, global markets, including Japan. So, in that environment, it really doesn't matter what BOJ says. What are they going to cut 50 basis points? No, they're not. They're going to at least maintain the rate and maybe slow down the pace of higher rates. Yeah, that doesn't change anything. The thing that's changed is that the US curve is no longer higher for longer. That has shifted. Is there's no way that Japan is going to offset that 150 plus basis point move that's moved in, like 2 year SOFR futures. So because that's not going to be offset, that's the flip that's going to drive these differentials and positioning. That's ultimately what it is. On the margin, commentary will talk about how BOJ might respond tactically to this, but you see the writing on the wall. There's not much that Japan could do. The thing that would be dovish, okay, like a truly dovish statement, would be something like, "Oh, where there's not this virtuous cycle that
yeah,
thesis is gone." That is dovish. That
yeah.
means
I
that
mean, yeah, that's
we're
what
back to cuts.
what I'm looking at. So, I mean, but I mean, like during the speech, Uchida is like expressing like relatively like, I mean, it's just like they are confident like this is happening. So I mean, that's like what made me kind of like also like confident that like the DOJ caving like view is kind of like, I mean, it's like a misread basically. So I mean, they're confirming
Right.
like the virtuous cycle is still there. I mean, they're observing like in their surveys and like the inflation expectations. So yeah, I mean, I think Uchida like laid out like plenty of like evidence, like saying like this thing's still going, and
So
that's
what do you
kind
do? You get long yen here, right? Like
I
that
mean,
should be your.
I mean, I was already long. Yeah, I mean, it wouldn't be like earnest like if if I'm not like talking my book a little bit, but yeah, uh, yeah. But I
Yeah,
mean,
I think by the way, like this is where I think it could go. I think you could get the yen to 110.
okay,
Why wouldn't it get down to 110? Given that we're in that flip regime now. Like we'll probably head back down to like 120, 110. That sounds
yeah,
that would be reasonable for the environment that we're in. The like if you look at, if you think about like the rate differential that's happened, right? That's really been this dislocation like post the COVID, experience. And so this regime is now flipping. So, structurally long the yen, I think makes sense. That's like a beta like view. And because it's still so underpriced, like we're so close to like the 150s, we're closer
yeah,
to 150 than we are to 120. So, you
yeah,
know, uh, still pretty attractive to get long
yeah.
there.
I mean, like the idea I presented in like our chat, I think it has like because I did like a more like long underlying over like the 1 by 2 overlay. I think the break even is probably close to 130 by the election. Um, yeah, I mean, but I mean, I kind of agree with you.
By
Like,
the US election?
yes, like the November.
Okay.
Um, yeah, but I mean, I kind of agree with you. Like, once like this, I mean, I think Japan is still like confident in their like, however, like they're slowing, but they're still like in the hiking cycle. But like the US is like on the cutting cycle, and I mean, I can agree like 120, 110, like in 1 year. I mean, that's not like far fetched. So
Yeah, we could see that. We could see that happen over, I would say like by this time next year, we'll probably be at like 120, 110, within that range for the yen. If you look at the rate, the dollar yen cross, right? Like it's you saw that like when inflation began to spike in the United States, that's what drove the surge. Like that's what drove the weakness in the yen, because it was all about U.S. forward rate policy. So as that forward rate policy is shifting back, it's moving the other way.
Right.
All of these like longer term trends in free floating currencies are always the rate differential. So
Yeah.
in the near term there might be like minor dislocations, but that's pretty much it. So
Yeah.
I think in the short term, by December, before December maybe, we could. I'm not sure if we can get to 130, but I think that we could for sure get to like 140. I think that absolutely
Yeah.
makes sense.
Yeah. My end of the year target is 135. So
Yeah,
yeah.
that would
Um.
be about right. What
Yeah.
are you using to get to that
I mean, for
to
this one,
price it?
I mean, I'm not like, yeah, if, I mean, it's probably like more of like, uh, I don't know. I mean, right now I still haven't like, developed like the quantitative tool, but I think it's just like more of like, intuitive, like feel. Like, I mean, this is like, of course, not, uh, because like usually I have like something there and I probably like need to find more supporting evidence for that price target. So I think that's what I'm gonna do like in the next few days. I'm just gonna back up like my price target with like real data. So, but right now it's more like a hunch.
So, I think I would say the way that you should do this, just follow the Fisherian model, the
Okay.
interest rate differential. That's what you want to do, and you
Okay.
just express it on like where the price is today. So, for example, if you have like, what is the rate differential change in the dollar? What is the rate differential change in the yen?
Okay.
You're gonna get a percentage change. You just apply that to the yen, and you know the
Okay.
direction because the yen would rise versus that. So you know that's how you do it. it's,
Okay.
it's and if you want to see like, and this is, you could just Google like international Fisher effect.
Yeah.
There's oh, shoot, yeah, this is literally what you want to use.
All right.
Yeah, just make sure that you're looking at reels, and you can fine tune it. But I would say start with just like the nominal yield, and then you
Yeah.
can fine tune it by then looking at, okay, what's the real rate, and then you can always fine tune these things, but start with that. That's going to tell you where this is going to anchor. And the thing that you have to understand is like, so how does this work? Well, it works because most of the currency, interactions are going to be like in the forwards and derivatives market. And
Yeah.
when those guys are pricing in the trades, this is what they're plugging in. So it's going to accrete to that value over time. Yeah, that's just all the flow is just going to price that in. So don't worry about, oh, but like, the level, no, don't worry about that, because everyone's pricing model, what, someone is calling Citi's desk right now and they're saying, hey, price me a forward, a 6 month forward on the yen. I got a payment, $2 billion payment I have to make. They're just going to plug this in. They're going to say, okay, where will the interest rate be at this time? And that
Right.
drives the Fisher effect. So that's like the efficiency mechanism for that. There can be short-term dislocations, and that's why you want to fade them if it doesn't change that underlying parameter. If you know that like tomorrow, when people call the desk again, they're going to plug in those same things. Like the question that you have to ask is, are people changing those inputs? If people change those inputs, then okay, the trade is different. And that's, in our parlance, we call that a change. That's a revision, right? That's why you always
Right.
want to know where's the revision and what's going to move it. But yeah, just just use the international Fisher effect. You can calibrate it by looking at, okay, real rates, blah, blah, blah. You can then look at like swaps or forwards to fine tune things. You might like, sometimes you might use like the 1 year forward. Sometimes you might use like an LIS. Like it just depends on, if for example, in some indices that track, there might be a time of the month effect, right? And so you might say, oh, for today, I prefer to use OAS versus, the index, and that's totally fine. That's like the calibration part. But you're just like, how like when we price a stock, it's just like the metric times the multiple. The same thing goes for pricing a currency. It's just the rate differential, and then that's going to tell you what that expected change is. Just multiply that by the currency, and that will tell you where the currency is going to go. So pretty straightforward there.
Yeah. Right. Yeah. I mean, yeah. I think what else today? I mean, today there's like a Bank of Canada minute.
Sorry, I was muted.
Yeah.
I
I
was
mean, yeah.
just
That's
showing
just like
you
one thing to
the
add. But
FRD screen
yeah,
that I was
I
trading on FX desk. So this is the tool I used.
yeah, the
So
followers. Yeah, I have some
yeah, these are the
calculators.
points. So like the rate is actually like spot plus points. So the points
Right.
is actually at the banks is a separate trading desk called third desk. So short-term interest rate trading. So you actually get the spot from the spot trader and the forward point from these third traders, and then you piece them together to give you this price. And this is something we reference to see if there's any screen arb. That's when we can charge you crazy rates. If there's Bloomberg makes a mistake, then everyone's looking at this. So yeah.
Yeah,
Um,
I'm actually looking at the dollar yen forward right now. Like 1 year forward is at like 140.
yeah, 140 is but
Two
it's like
year.
this is what everyone's trading to.
Yeah, right.
If you have incremental edge over that, then you can trade this and make a profit.
Yeah, and 2 year is at like 135.
Yeah.
So
The
So
data is same everywhere.
the one thing you guys want to understand about these is that, so when you're looking at the forward pricing, right, that's going to be based upon it's based upon like what's happening today, right? So like
Mhm.
like what Andy said, right? So the trader that's putting that in, he's gonna like ping, he's gonna IB the spot and the stir trader to get two inputs, right?
Yeah.
But that is not a view on what's gonna happen in 5 minutes. It's not a view on what's gonna happen in an hour. It's not a view on what's gonna happen tomorrow. That's what it is today, right now. So
Mhm.
like what the trader cares about is they want to lay off risk right now for whatever the price is right now. And so it's not going to incorporate the forward view. On the buy side, right, the price takers, like we're gonna be the ones that have a view, and we're gonna say, okay, well, right now on screens, the 1 year forward is 140, and we're like, oh no, we think it's gonna get to 135 by the end of this year. So that in that case, you know, that would be cheap for us, right? We want to go long that, or
Mhm.
that would dictate our strategy and how we respond. And
Right.
that's like our view.
right.
But it's important to know that like that activity that's done on the trading floor is what drives that accretion to price. And then but we have to have like we have to know where price is going to settle, or like where it's going to go, right? Because
Mm.
at any given time the price that's being priced is for that second,
Yeah.
good for 20 seconds or whatever, or 90
Mhm.
second window, right?
Yeah. Otherwise, you got a ref. Yeah.
Yeah,
The roughing part was the funniest thing, in FX trading. I didn't have to do that on equity that often, but on FX, it's like 5 seconds, you got a ref, got a ref, got a ref. Um, yeah. So yeah, just want to share the screen. So
yeah,
yeah.
yeah, right.
Ah.
Yeah, I mean, just like I think there's like Bank of Canada minute. I'm probably gonna read that afterwards, but I think that's probably like all the macro, and I can transfer to like you guys for like the equity tape.
Yeah, I think
So
so just to kind of quickly comment on some macro stuff, right? So like,
Yeah, sure.
couple of things for today, like two besides the 10-year auction which came in pretty soft, right? But besides that, we had two kind of incremental data points. We had the MBA mortgage applications that came in a bit better, right? 6%. We also had consumer credit. That number came in quite soft, right? Missed by about 2 billion. And so the question is like, what are those two data points? Like, what are the incremental to? So the mortgage application data, that's going to be incremental to like a potential rebound in housing. Now, the thing about housing is that housing market has cooled, right? Just inventory's gotten tight. People don't want to sell because there's not enough buyers, because prices are so high, because total cost of purchase is high due to higher interest rates. So in this dynamic, right, there's just like a low amount of buyers. And so this is where it's really important to think about like not just like the change of mortgage applications, but also the level. Because we're at such a low level, you can see like a high change, but it doesn't really tell you anything. Um, Given also the direction of like credit conditions, it seems like housing is moving towards a much slower path, towards the end of the year. In fact, and the like the input that I really attract to is like with Zillow, Redfin, what these guys put out. And they have their own proprietary indices like Sorby, and Zove, which is like their observed house value index. So those are useful benchmarks to see what's actually happening in pricing. And what I like to do is I'll look at different markets. This is not an informational edge because everyone else, can access the same website. But it can be analytical, right? If I'm tracking it to a certain thesis, such as I know that in the U.S. housing market, speculative markets will move faster than traditional markets, right? Or high population markets. So, you know, California has already kind of cooled to some degree, but what's really gonna like tell us about what's happening is how housing is responding in Florida, how housing is responding in say Arizona or Idaho, like those kinds of speculative real estate areas. And actually, if you look at the Zillow indices, you'll see that Florida is really, really weak. So that tells you that that's kind of, this process is already starting. So, when is it going to bottom out? Should we take signal from a 1 month of 6% growth in mortgage applications? No, this is part of just a decelerating process. It's going to take probably another year, for this to, bottom out, you could say. So that's incremental information that helps us understand what's happening in the housing market. Does this information shift our revision up or down? Doesn't change doesn't change our estimates. Consumer credit, that was helpful because consumer credit is very cyclical, is very correlated with the economy. If you look at consumer credit trends, they have completely rolled over for the cycle. So yeah, I mean that was incremental information that tracks to severe slowdown thesis. And I think that the right terminology that I want to use is I want to call a severe slowdown thesis because it's not necessarily a recession. Okay. It's just a severe slowdown. So it's like market is expecting 170 basis points of growth next year. Probably going to be less than half of that, right? So that's a severe slowdown. So in that dynamic, what does that mean? It means that, you really want to understand the economy from like a late cycle standpoint. And the more that we track to what's happening late cycle, the more evidence gets stacked up. Now, for jobless claims, I think that we're gonna have to wait until next week before jobless claims we get to move a little higher. The reason why is because I believe most of the like retooling is gonna happen towards the end of the month. So like that's when we would get some additional, keep in mind that the retooling that happens in Michigan, that's part of seasonal adjustment. So like people already incorporate that into the forecast. So I'm not like, it's really important to see through one-time events. Don't, if you know that like, oh, this data point's going to be out of whack, but then like, but that like the next print is going to move back. Don't trade that. Like that's, we call that like peak on peak thinking. No one falls for that. You're gonna be the person holding the bag. So, but the thing is that like, so the fate of peak on peak is someone who sees a modestly inline print tomorrow extrapolates that to mean that, oh, there's no problem in the labor market, right? That's similar peak on peak sort of thinking. And we want to avoid that too. So I would say, kind of going into Jobless Claims tomorrow, we should see probably an inline print. I don't see any. There's nothing that I'm tracking that's nothing none of the catalysts that I'm like watching for line up with tomorrow or line up with like the first 2 weeks of August. They're more about what happens in the middle and towards the end of August, and then as we move into September, how does that data kind of flow through? On the flip side, there was a marginal contribution, right? A marginal impact to jobs from Hurricane Beryl. Now that we're through that, could that data, right, be positive, tomorrow? I think that there's a little bit of an upside risk because of that. But we'll see how this plays out. Again, and if someone were to take that as like to extrapolate that, hey, data's gonna be better, then I would want to fade that move too. Ultimately, the data has been pointing in a direction which is lower. If you think about the story of the past 6 months, it's really been that data has pretty much consistently surprised to the downside since April. And people have just been giving excuses for why the economy is actually doing better than you expect, right? And so initially it was, oh, it's like a vibe session, and then it turned into something else, right? And now people think that there's, maybe a, I don't know, like I constantly I'm hearing of people that are saying that actually there's going to be some reacceleration, but there's really no evidence of that. And the thing is that actually, the really important signal is where we are in the beverage curve, and this is the thing that's like really my worry, which is, the beverage curve, just kind of like looks like a little oval, right? Like a flattened oval that's at an angle. And the problem is that once we move to like the nonlinear part of the oval where it begins to drop down, it can move very, very quickly. The whole like challenge around that is, when you think of the process that like a recession, for example, or like a contraction, it's a process that happens. And what drives the process is a series of feedback loops. And what triggers these feedback loops is just marginal changes. So if I have like just a little bit more marginal unemployment, in say from manufacturing, just a small little shift in manufacturing can drive a reflexivity that happens on the services side and drives further unemployment there. So I'll give you a good example, right? Imagine a small town of 100 people where 10 people work in manufacturing, 90 people work in services. Now, hiring managers for manufacturing, right? They're seeing lower new orders. They've seen lower new orders for like 2 years now, right? But they've retained their staff because they were hopeful of a improving economy. Well, interest rates have remained high, and so we're at the point where backlogs have dissipated to the point where you now have revenue headwind and margin concern. So what happens is on the manufacturing side, you lay off one worker. Okay, you went from 10, now you have 9 employees. While the 90 service employees were the market optimized to the 10 manufacturing employees, right? That was like the balance in there. Now you've disturbed that balance. So what happens is on the services side, there's one less person who's buying things or getting haircuts or whatever. And so you have 2 people that are let go. Well, that then means that all the barbers, they're no longer buying their machinery, and so that becomes a negative feedback loop that goes into manufacturing, and you get this recursive process. So the thing is that people like the big thing that people are talking about is manufacturing is a small segment of the total economy. That's totally true, but nonetheless, just even a small change in that manufacturing sector that's not been accounted for will create this like wave effect across services. And so I think that's something that's like very important to pay attention to, especially given how like you know uh there's a lot of circular references because you have like, at the end of the day, you have the services sector is so large that, there's a lot of reflexivity in that too. Your barber shop owners go to, Starbucks, right? So if there are fewer barber shop owners, there's a lot of Starbucks that's being purchased, right? And so these kind of feedback loops can accelerate pretty quickly. And so that's the worrisome, sign. Um, so I think it's very important for us to be like plugged in. I don't want to say that we're on recession watch, but like we're on severe downturn watch. And that's not in a recession. That's just like bringing down our growth outlook, but still it's very key. What I think is very very interesting is we're starting to see the sell side catch up, right? So today, JP Morgan came out, right? Casman comes out, and he's saying, okay, he's lifting the odds of a recession. Even Hatzius came out and lifted his odds of recession, right? So it's now at 25% at Goldman. And so we're starting to see that this acknowledgement. If people, if that wasn't the case, then you would see a doubling down of like, no, there's no recession, like there's no worries, right? We're actually fine. But actually, what you're seeing instead is that the economists understand the risk of the beverage curve slide. And so they now know, okay, we need to get in front of this because otherwise we're going to be, out with this like really strong view for next year, which is going to make us look ridiculous. So that's a very important sign. Another thing about the markets is, um, don't we shouldn't get caught in the trap of looking for direct feedback from the market. And what that means is that like price in the near term, right, is somewhat random. I mean, you can try to explain it by flows, seasonalities, so on and so forth, right? But to some degree, it's going to trade away necessarily from information. And that's why you can't learn a lot if all you do is look at price, because price is constantly whiplashing you, and every time you think you know what's happening, it moves in another direction, and then you just go back and forth. So instead, the thing that we need to track is revisions, are the estimates, and what's happening. We're seeing estimates are starting to finally move lower, right? That's been the thing that we've been calling for. So I'm not concerned if tomorrow the S&P rallies another 2% in the morning, and then by close it's down 1%, because that doesn't change what's actually happening. I know that in a month from now the market's going to be lower than where it is today, for example. So that's kind of how we want to evaluate things. And then we could think about, okay, like what in the near term would create some divergence. And that's where we can say, okay, well, people still aren't positioned. So because people aren't positioned, what's happening? They're reaching for puts, right? Or they have to readjust their portfolios. Some investors, there's a lot of investors, by the way, that only trade like once a month. There's a significant amount of investors that only trade once a month. You also have monthly and quarterly and not calendar quarter rebalancing that happens at like a pension fund level. There are like the series. There's a bunch of these like equity hedged funds, and I don't mean a hedge fund. I mean like a long only fund with an equity hedge, which means that it's a long only fund with a put component. And these guys are rolling, right? They have to adjust their position because either they put in a collar, that collar, the range is going to shift, um, and so these are the things that will drive uh, the sort of a reaction. Now, in an orderly reaction, you would expect that equities would just kind of grind a little lower, and then you would see the VIX would slowly just like grind a little higher, plateau, and then begin to recede once people are positioned. But obviously that nothing happens in a perfect world. So what happens instead is I go out, I'm either a fund manager or I'm an investor. I go and I buy puts right now, okay? And in the market, or say I bought puts, today at close. the market tomorrow, rallies, at open, mainly because, at the close, the dealer position is set, right? And then overnight, what happens in Asia or in other markets, or how futures are moving, based on information, right? Like maybe there's positive earnings or something along those lines, moves futures up like 20 basis points. Well, that might actually have a really massive impact on the charm, or like the theta that the dealer has, right? And so what they'll do is, in that situation, they're gonna need to either reduce their position, or they'll need to go aggressively go along the other leg. And so in that dynamic, you get that very interesting like morning reaction and response, where like the market will just like spike up really quickly, but there's no actual subsequent demand because no one is changing their minds. Like there's no information that says, oh, actually the economy is, we're moving in a different regime. I mean, the regime is pretty much set. So now we need to be hyper paranoid, because we need to make sure that if the regime does change, we know we're in front of it. So I'm not saying that it can't change. I'm just saying that that's what we want to make sure that, okay, it's not that the regime has flipped. It's just that, and I'll call that like seasonal wonkiness, or like market microstructure that could drive price to diverge from information. And if you on like for me, like I know that there are all these zero date expiry, zero DTE, right, trading that occurs. And so there's a lot of people right now that are like preconditioned to buy the dip. So every day, what are they going to do? They're going to try to buy a bunch of call options. And so you get this like repeating action that happens. But if you just look at close to close and see what's actually happening in the market, it's telling you a much clearer picture, which is that people are just, whatever positioning that they have, they're probably trimming equity exposure at the end of the day, right? And at the margin, you have smaller players, or that are trying to punt, and that's what creates a little bit of like a weird action. But at the end of the day, this is not what's going to drive like sustainable flows. And the way that you should see flows are really like set quarterly, semi-annually, annually, right? Like that's like the big thing. And they're typically set. I mean, you have like, every investment committee is going to meet in the next probably around October, to figure out what their position needs to be for next year. Okay, so they're going to make decisions around how they want to invest for 2025 between October and December, and then they're going to position that way, and and that's going to then set the tone, right? So if you know how people are thinking and how they're positioning for, you can then determine, if new information comes out that changes the scenario. Oh, there's a gap that's emerging, and eventually they're going to need to have to cover the gap. And that's what drives that like reaching and like aggressive repositioning, which can drive up equity markets, or create a dislocation. So on a macro front, when we think about like trading equities from a macro, like a global macro perspective, we don't want the beta, we just want the alpha. And the alpha comes from understanding that positioning, right? Knowing like the sequence, like how do these people operate, and what do they do when they need to reach? Like, for example, an easy trade was like, again, the beginning of 2024 was like, this is a classic pattern that you guys really want to have like memorized, which is the setup was recession worries, from all of the investment reports came out from October to December. Vast majority of the sell side were all on the recessionary camp. That led to the number of cuts, right, that were expected in interest rate probabilities by 2024 to be over 7. And that meant that investors were underexposed to equities at the beginning of the year, right? So if you were a global macro guy, you were not gonna go like long or short an equity index because it has like momentum, right? Because you would have shorted the U.S. market if that were the case. The CTAs are gonna do like the trend following. If you're a global macro, you're not gonna do a CTA. You have to think of like your idiom, what's going to drive some big gap, and you would be like, oh, I want to fade this because the data doesn't look that bad. Everyone is positioned, it's crowded, um, there's no reason that the Fed is going to have to do 7 cuts, this year, given the data that we have at the time. And so in that environment, you go long, and what happens, all of those, and what the catalysts are. Okay, well, I know, I got, these FOMC meetings, these economic release points. You see each of them as like, these are either going to create my direction or they're going to like deny, my thesis, and we'll see how this plays out. But that's like the big thing. And so we want to keep that in mind when we're reviewing things, because at the end of the day, global macro is very tactical. So when we think about like, what do we think is happening at the macro level, it's really important to focus it on what's the tactical, like, what does that mean in the near term? How does that mean about how we're positioned? Where is the trade? How would that feed through? How we're going to know that we're right or wrong? We kind of go from there. So, I think I rambled a little bit, but that's my macro input for the day.
Yeah, you definitely see this pickup in volume, on the AVAT chart, right, over the last couple of days. And I've heard multiple friends of mine saying, buy the dip. So, yeah, I'm with you on that trend. Yeah, James, anything to add on that topic?
On macro, my view hasn't changed much since yesterday. So still, positioning wise, it puts me in a slightly lean short kind of posture. And I'm looking for short opportunities more than I'm looking for long opportunities right now. Though I'm finding a good mixture of both, actually.
Is this on the long short side, or in a macro, from like a macro standpoint?
Well, from a macro standpoint, like my view is unchanged since yesterday, which is that we're seeing GDP contraction, inflation remains stubbornly high. So that's a stagflationary type of posture, moving a few ticks to the left towards deflationary. And so I expect that trend to continue until the Fed hits the red button and postures a rate cut, and I think that's going to signal a further contraction in the equity market. So my bias is short in equities on macro. Normally, like in a normal situation, I would also be quite bullish on commodities and metals in particular. But
files, but I wanted to check on the price.
Someone's talking also.
No, I think.
Sorry.
Yeah, so normally I'd be pretty bullish on commodities, but commodities have had such a run, metals have had such a run, that I think that's kind of exhausted. So it's a little bit weird because there's more correlation creeping in certainly between all the equities, but also between asset classes right now, as you expect when volatility goes up. So the long duration treasuries have started to take off, which is kind of expected. I might be getting increasingly long treasuries as well if this, if the data continues to point towards contraction, then that's gonna be long duration bonds and short equities. So, but right now it's just call it like a weak short kind of thesis. So I don't have. That means I'll keep my net exposure to beta, under 10% net short, right at 10% or under 10% net short. And so I'm still looking for a healthy mix of inequities of long and short opportunities. Mostly around earnings right now. I assume you guys are all the same.
Yeah, I think from like a earnings standpoint or like a single name standpoint, I mean, broadly speaking, our portfolio, I'm at on a beta adjusted basis, my net is about 16%. On a cash delta though, it's closer to around 7.5%. And so like in like today's move, for example, we were like roughly flat. I think I was up like 2 basis points.
Yeah.
But so that's kind of like the way that I want to run the book. I mean, I I had a couple of earnings that reported today, but I didn't have any of the positions in size. These were just like smaller positions. You know, those were we had a Dynatrace and Fauzi, HubSpot, and Shopify. You know, all reported, and so you know, pretty kind of positive across the board. But you know, again, I'm more you know, I've been like reducing my gross dramatically just to kind of keep us keep my keep me within a very like narrow risk parameter. Now on the you know, from like a names standpoint, you know, I mean, I've got like another good, I want to say around like I've got like 45 companies in my coverage left to report. So, you know, what I try my best to do is cycle through, you know, the earnings, and obviously it depends on like what my expected returns are. So like, you know, at the beginning of or right before earnings season, about a week, you know, before earnings season, you know, I go through my coverage and I'm like, okay, you know, these are like all my views. What has the highest IRR? And you know, I want to like match those higher IRR positions to the weights that I have in my portfolio. And then as we go through the earnings season, right, like as names are hit, I'm either exiting them or I could revise them higher. Or, you know, I'm recycling through names. If, for example, at the beginning of the quarter, a name might have had like a 5% IRR, and then by now it might be at like a 12% IRR, right? So like now I want to go and add that position in. So, you know, these are the things that kind of like naturally happen. And this is like part of the, you know, your idea of velocity as you like rotate through positions in the book. So like I'm doing that, but those are all, you know, very bottom up driven. You know, I don't like to you know, I like to see macros completely separate. So those would be like either, you know, positions at the index level, but not necessarily on company level.
Yeah. So I use macro to set my desired exposure to beta, basically. You know, so if you know, if we're in the Goldilocks zone, you know, I might get up to 50% net exposure to beta. Of course, we haven't been in that zone in quite a while. And so, you know, for the last few quarters, it's been, you know, week short, week long thesis. And, you know, the reason I do that is because it's kind of like in a mathematical sense, right? It's like if, you know, you're estimating essentially like the amount of the return that is going to be driven by beta anyway, right? So at a certain point, like usually when volatility gets high enough, right? Like, well, beta dwarfs everything else. So you might as well just be long or short the index or neutral, right? So like the reason to own, to me anyway, like there's the reason to own single names, long or short, has to be related to your desire to be long or short beta anyway, right? And so in, you know, an ideal world, you know, we love to be in like a neutral zone where we're like market neutral and long and short, and you know, we're realizing pure alpha. But that is subject to the whims of macro. So that's why I look at macro. And I guess one thing that's different, you know, since I met you, Wahdy, you know, is like I used to dial in on well, for one thing, way more quantitative and, you know, technically driven stuff over the years. But like since I switched to being more fundamental driven, you know, I didn't used to have a consistent coverage at all, you know. So it's kind of like go where the, you know, go where the flow is going, right, and pay attention to that stuff. And so one of the differences is now that like I'm building up a consistent set of coverage. I'm up to like 35 names that I cover all the time, versus stuff that I would look at, you know, within a window of like 20 to 60 days, driven by a catalyst, usually earnings or some technology conference or something like that. So that's a long way of saying that like that's really helped, because I would lose context in things that kind of drifted out of my coverage because they were unpopular, you know. Like I remember like last quarter, I think you caught a trade in Micron, you know, because you're covering it and you know, you're paying attention, and that's the sort of thing I would miss just because I wasn't covering it anymore, right? That style, though, it lends me to find certain things. Like I keep it up, right? Because it lends me to find certain things. And so there's a number of things to report. So I also was long Shopify and HubSpot. However, like I posted in the chat, HubSpot was like that vertical where I clicked the wrong line in the ladder and set the wrong price and set the wrong quantity as well. So, if I make money in that, it'll just be by, I've like made 3 mistakes to get there. But, I actually put like quite a bit of analysis into HubSpot. So I was very, pretty sure of my conviction, and I actually flubbed that trade just by my visual impairment gets the better of me sometimes. So we were talking before you got on the call, like I'm gonna get, and you're joking, like give me the old man magnifier, yes, but I'm gonna get like bigger screens. I'm running on 27s over here. I need something a lot bigger. So coming up, we have Elf, which has been a great name to me. We have the Trade Desk, which I think is also in your coverage, isn't it, Mo? Don't you cover TTD?
Yep.
Yeah. So TTD is coming up on Thursday, right? Tomorrow, after market. That one looks pretty good to me for for earnings. This is a stock that tends to move. And by the way, as we always say on this call, it's not trading advice or anything. I'm talking about my own book over here. Consult your professionals. This is a stock that tends to move, on average about 10 to 14% in that zone. And to my target, it's also revised higher both on top line and EPS in the last month, and I think it has pretty considerable upside to it right now. So I think combined, with the likely move would be about 12 or 13% on the print, and then probably a little bit of PED following that. So this is one that I'm looking at. I don't have anything on, but I'm looking at getting along tomorrow. I'll have to go see what structures are going to have. I noticed also that multiple has drifted lower on this, and it's probably at the bottom end of its range of the last year. So I think this is one that could go up a bit, even though. So what do you think of this one, Mel? I know it's in your coverage. You probably know this stock better than I do.
Yeah, I mean it's definitely interesting. I do like the name. Structurally, so the story is so here's what the story is. The story is, right, connected TV, CTV, right, is getting shared to linear, right? And so in this dynamic, advertisers are spending more money on, platforms that are, that are part of this like connected ecosystem. So that's like the backdrop number one. Second backdrop here is where ads are actually like placed and spent, right? So you have a concept of like walled gardens, like say Google or Apple, and then you have like open gardens, which is the Trade Desk, which is like an opt-in, system where as a consumer you can kind of click to opt into to the cookies, that tracks you and creates like a persona based upon your web traffic, right, or web activity. So these are like the dynamics that are happening in the backdrop. Fundamentally, this is a story about ad spend. Okay,
Yeah.
where we are, it's a story of ad spend. It's also a story of the acceleration of connected versus linear. Okay. And then the third thing is it's a story of the DSPs, so demand side platforms, working in a system that is right now going through a little bit of disruption. So there's like a post-cookie world that's emerging, and that story I still don't have like a full grasp on. So like that is a big risk thesis or a big risk scenario to the Trade Desk and other existing DSP or even SSPs. Now, right now, revenue mix looks pretty good. Okay, ad trends look pretty good. So fundamentally I like the trade desk kind of going into earnings. I feel like, the multiple has given back, but obviously the market is lower. So, there's that dynamic. I feel like the Google cookie depreciation, that headwind has been removed. So this is positive for the trade desk. I also feel that political ad spending it's going to increase dramatically. I mean, we just saw that the Harris campaign, how much have they raised in the past like month? 200, 300 million. I don't know. Every time I look, it's like another 100 million. So that's going to have an impact on the spending that we're going to see through the quarter and next quarter. So this backdrop is pretty positive. So I think like structurally, I like it because of that. My like price target, I've got a price target of about 100, but it's really based upon three underlying scenarios. I mean, that's what it tends to boil down to, about three different scenarios. There's one scenario which is actually the trade desk is on the right track. They're not going to get disrupted by a post cookie technology. Or they're going to adopt it, right? So in this environment, you get the trade desk that can accelerate revenues again and really build off, as the world moves away from linear into connected TV. The incremental data points that support this is the strength of connected TV, right? Of CTV. We saw this with Roku's earnings. So I think this is a positive dynamic, and that could take the stock to 120 easily. You could really start to see the company reaccelerate and grow further. That's scenario one. Scenario two is probably around that is about $95. In scenario two, the headwind around Web 2 or about the post cookie world that isn't resolved. We don't know. We still don't know. That's like pushed another 2 or 3 quarters. CTV growth is okay, but it's offset by weaker SMB trends. So that's scenario two. And that means that, okay, we just kind of get like in line and earnings end up being a little bit of a nothing burger. Stock can trade up, or even it trades flat. That's definitely possible.
Yeah.
And then scenario three is you start to see revenue deceleration driven by a mix of a post cookie environment, also much weaker than expected SMB trends. So this is a thesis that I actually am a little bit concerned. I've revised up the probability of that thesis occurring. So even though my price target is roughly about 100, earlier in the quarter, I had it closer to like 110, and it was like looking at adding into the name before earnings. But because of this backdrop and this like shifting dynamic, I've actually revised my price target a little lower. I don't have a position in the name. I'll be reviewing it again through tonight and tomorrow before the print. And it's possible that might change, but right now I think that's the big concern, which is that the softer outlook could weigh on performance because we could get a weaker guide. So in that environment, I'm a little concerned. At the same time, I think fundamentally, I do think though that like if it even has an inline print, and if they can guide in line, I think there's no reason why the stock shouldn't be trading at between 95 and $100. The question is, the real risk is, I'm a little worried that they may say, hey, there's some macro weakness ahead. And if they were to say that, then that means that you're not just going to see, it's not just this quarter, it's like the full NTM shifts, downshifts because of that environment. So,
yeah. Well, for that reason, kind of give you what I was thinking, looking at the technical side of it, which is that, the current implied earnings move off of, ATM vol 10 days, 11.5%. The average move in the issue is 13.48%, and the max is of course 36% or so. So this is a stock that can really move when there's a change to guidance or a surprise. That being said, the last 19, was it 1, 2, 3, 4? Yeah, last 10 quarters of earnings, vol has been rather underpriced. So if you just bought straddles in this thing, for the last 10 quarters, you'd be up quite a bit actually. Just in raw returns. So this is also the quarter where there's the least sort of dispersion in their earnings and in their moves, right? So they tend, for whatever reason, I'm sorry, we'll get the wrong number. This is the most dispersion. So for whatever reason, like this is the hardest quarter for them to get right. So I give it like a long vol kind of trade here, long gamma kind of trade here, looks pretty appealing. And we'll see how it's pricing tomorrow. That's kind of really the key. Vols came in today about 240 bips. So, it's paradoxically a little cheaper into the print, and that may be one way I go. The other way I might go is look at the curve, the skew, as well as the time skew, and see if there's a little bit of edge. If I can price something, that's short vol, a little bit outside of that IAM of 13.48%, that's delta bias on the direct. Like I think, so one thing is the read through. Fundamentally, the read through is like Meta had an incredible quarter for advertising spend. Actually, Google did very well as well. But Meta, I think, had 11%. It was up 11% on its digital advertising revenue. So I think ad spend is very strong across all of digital. And I think that bodes well for this print. Anyway, that's the color I have to add to that, is that I may end up just being long gamma into this with a bit of delta bias in the direction that I think it'll go. To do that, you always kind of have to survive the vol crush. So I tend to price it a little bit out on the curve if I do that. So I won't be buying, if I go long gamma, I won't be buying like 10-day options or 1-day options. It's just because of the absolute vol crush is too high. So I'll be looking at September and maybe October, again, biased in the direction I think this thing's going to run anyway. And if I'm wrong, I take a little punch to the nose and dump it. If I'm right, I trade into something else. So I'll trade into more of a vertical structure to follow the PED. Does that make sense?
Yeah, I'm actually, so one of the things that I didn't like about the trade is that I couldn't get really good asymmetry. Couldn't get anything that was going to do like a 5 or 6 plus payoff. And if I only get like a 2 or 3 times payoff, it just I don't like those as much. And then I'm looking at the August 9th contract. I think though that you could, yeah, that's
I mean, if you want asymmetry, which I do too, like I was looking at more like this is maybe one of the longer duration trades if it goes the way I think. But just looking at like a really short duration trade, like 1 day, then you can kind of structure an asymmetric fly on either the Aug 16th or Aug 9th. Yeah, I mean, obviously that move is very well priced into either of those two contracts. I think given the pricing, I'm like, why are these so cheap? I was looking at verticals. I'm like, why is everything so cheap? Yeah, there's a good bit of juice in that. So you can kind of, the way I'll usually structure that is to buy, like if I'm bullish, which would be a little bit, I'll tend to buy the 50 or 40 delta call and then write the 20 or the 10, and then buy a little further out of that, so that it looks like a vertical, except that there's asymmetry in the peak. So it's like a lopsided butterfly, and kind of futz with it and see what the model the vol crush and see what that looks like. and make sure that it's a higher risk reward than, than just owning the thing. Because if it's higher, the vol crush, I mean, actually looks pretty steep in this. So let me look at that. Yeah, so the forward should trade, vol should trade after the print should trade 33. We're currently trading at 69 on the 30. On the 10, we are trading much higher, I presume. Yes, 100 and 106. Okay, so we'll we'll crush all the way down to easily to 69, and probably actually somewhere between 43 and 69. So what does that put us? Well, on average, looking at the past, it crushes all the way down to 40s and high 30s. So I think that's really likely, right? So there's probably on a print to target, like near the target price. That's where I like to write the short strike generally, and that's probably going to be in this case. I'm not looking at it. I think it's probably going to be around 20 deltas or something. Is that right? Yeah. Because by the way, my price targets, just to share, I have two, low and high, but they work out to be exactly $99.97 and $103.08. So it's pretty close to your target of about, you said about 100. That's pretty close.
So actually, I think I have a decent trade. I think I could go and let me just double check this again. I think I've got something here. So I think that there's like a good risk of upside. Like I think there's a good chance that they actually hit that. It's either going to be like that 120 scenario or it's going to be like that 70 scenario.
Yeah.
And I earlier in the quarter I was more bullish. And then through the quarter I've gotten a little bearish just from some of the commentary around like SMB and how that how that's going. So I don't mind taking a loss if it goes to 70 if I have a defined loss.
Yeah.
But where I would want to get the upside is like the cheapest upside to like that 120 print. And I could probably do that by, a butterfly. If I did 100, 100, 110, 120. It would cost me like $50, $67. Like one of these contracts would cost me about, 60, $67 to put on. If it hits 110, it's a $900 payout. So that's what I like. That's the asymmetry. If it gets to between 105 and 115, I'm gonna do around say $300, which is still a 5x, almost a 5x return. So I'm kind of liking that. I'll do that like in really small size, because I don't have a lot of conviction, but I do think that yeah, it's either gonna hit like that 70 or it's gonna do the 120. And I was a little bit more optimistic about the 120. Some of that has faded, but that could be misread. I'll dial it down a little bit more tomorrow. But something like this looks really good. The 100, 110, 120, nice vanilla, good payout. You pay 67. Your peak payout is over 900. Yeah, I like that asymmetry.
Yeah, that's a that's a very OTM fly, obviously. So that's going to be what, like I usually price them, like where the peak is at the implied move, and
I don't like to do that because that's literally that's like the price today. For me, it's like the peak should be my price target or just a little inside my price target.
I thought your target was 100.
So my target was 100 because of these two scenarios. I feel like there's a risk to the downside because if they communicate something about some softness in SMB, okay. However, I think, but then there's also this like really good upside scenario, and that upside scenario is, that CTV because there's strength there, like there's tailwinds, from that, could, offset or could be driving it, right? And if that's what's happening, then I'm pricing the stock at it can go up to 120.
Yeah.
And near term that would be like, yeah, by Friday would be 110 or something like that. So yeah. So I'm like, well, okay, if that's where I'm pricing, then yeah, then my peak would be at 110. That's where it was before I made my downward revision. So yeah, price it at that, and then plus or minus the standard deviation, of like the normal move given the amount of time. Okay, I'll still make like 5 times if it lands within the range. If it does my peak, that's like 12 times. And if it doesn't hit, okay, I lost $67. But it's not a bad trade, given that I think that there's like there's a decent chance, I would say like a slightly over 50% chance that we actually track that upside thesis. So don't, obviously not financial advice. Don't put this trade on yet. I need to confirm some stuff, which I'll have confirmed tomorrow. But yeah, that's kind of that's what I'm thinking. My only thing would be, so there's a couple of things. One is that I may have mismodeled next year's revenues, and it's not like it's like something wrong with my formula. It's that I might be overestimating the positive impact from CTV, and I need to, and I have a call with one of the sell side analysts tomorrow, so I'm going to ask them some questions to confirm that, like, okay, this is tracking. This is like I'm not like way out of left field here.
Yeah.
And if that is fine, then I would say that yeah, my conviction holds. But again, what this is I'm kind of like, yeah, there's like a 55% chance that it's going to be like between 115 and 120, and a 45% chance that it's going to be like a 75-70, outcome. And that's because it's either going to be, this macro headwind risk, and which means that again, it's all about like next year. What does that mean about the terminal? That all would have to come down and get compressed dramatically. Or it's that we can see through that dynamic because the CTV trends is ultimately what's driving us. Now, the last 2 quarters have been very noisy for the trade desk because of this whole Google cookie depreciation issue, and then some other things along those lines. And so that's where there's just like, I don't have a lot of conviction because of how chunky things were. So I don't mind putting on, a small trade. I'll take a little bit of risk here, but right now this is like kind of how I'm thinking about it.
Yeah, I like that fly. I also like the asymmetric calendar. So, you could kind of take the 90 strike at, yeah, I quite like that actually. So you take if you're looking at 16th August and 20 September, you can short the 90 call by the September 90 call. And that's going to give you, in a ratio of 3/2. Okay. And that's going to give you effectively 54 deltas per spread. Okay. So just like being long stock there, the difference is that with the vol crush, it's going to earn asymmetrically from ATM all the way up, into your target price. And then above your target price, it's going to be asymmetric because it's long stock. It's just going to be long stock. So basically above 100, you're straight Where's the delta max out? If you max out 100 deltas at, yeah, at $98, you're 100% long stock in this trade. Below in the 3x2, your per spread, you're at 54 deltas, 59 deltas, like at $90. So, it earns per risk, it earns almost 2 to 1 at a print of 90, almost. Above that, it just gets better and better. Obviously, if we hit your 110 or 120, that's pretty good. You're getting 5 to 1. No, 4 to 1 almost. So I might go into something like that tomorrow, especially if the curve shifts just a
Why?
bit.
So here's a question. Why wouldn't you sell the 9th and buy the 16th?
Well, because the vol crush is going to be proportionally a lot higher in the 16th. Yeah, so you need a different ratio to accommodate that, and that's going to be really hard. Like there's basically just too much sensitivity to the vol crush in D2. That's why. So if you just look at the way to eyeball it is like if you just set your ladder to be single strikes, you can kind of see, vol at 2 days is 200%, 207. Then it goes 110, 89, 76, 70, 56, 65, 57, right? So it doesn't really flatten out until D3, which is, what's the fourth one in? So it really doesn't start to flatten out until September. But the whole vol surface is elevated relatively into this print, so it's kind of priced, whereas I lost my analytic window. Earnings, yeah, so it's actually, I think that it's priced right in the middle of its historic implied earnings move. So it's right in the middle of the bell curve. So, but it's underpriced versus the absolute realized moves. It's actually underpricing the tails. That's the situation. So, you can short that 16th OG, and that's going to get you plenty of sensitivity to the vol crush. But the September duration is going to be a little bit less. And if we model that, I'm just going to make sure I've got the right crush in now. So, yeah. So like the front month will go down 60. Yeah. Yeah. So, that'll get you a bit of sensitivity of the crush from 90 strike on. Actually didn't have that forward crush in. So it's about 1 to 1 on the 90 strike, and then better, above that. Turns into, with that model, it turns the long stock by 95. So,
and are you trying to be Vega neutral, or you're shorting Vega here?
You're shorting front month, because the curve is backwarded, right? So what it'll do is it'll completely flip into contango in general. And a lot of times the rear, the D2s will also, the whole curve will sack, sink on the print. And so, but you tend to earn more on that, that front end vol crush, because you've only got, in this case, 10 days to expiration, right? So all the juice will come out of those 10 days, because the event risk is gone, right? So basically nothing's going to happen in the next 10 days. So those will be worthless, on the print pretty much, unless they're in the money, So sometimes, even when you're wrong about direction, this trade will still earn, because you get the strike you were long gets further out of the money, and actually the smile comes back in, right? So you actually make money, a little bit of money, because we're walking up the smile. Right. So that's you have to understand how the curves change, right? I mean, I'm sure but like right now, I'm not looking at it, but I'm going to guess, because it's earnings, right, that the skew will be really flat, just be almost completely a flat line. And then what will happen is that the skew will come back, it'll crush in the middle, and you'll have tails again. You'll have a nice smile as soon as the print comes out. And then of course on the time smile, will completely flip into contango. So that when you're long the calls, that can work to your advantage, especially if, because of the print, like, it's kind of interesting, right? Because like if the stock sags, then people start to price in that reversion, right? So you'll see the call smile lift even further, sometimes. So like it doesn't always happen that way, but like I've accidentally broken even on a wrong trade or maybe even made a little money on these quite a bit. My single best trade of the year, by the way, was this exact structure in Meta, because Meta blew out 30%. Was it 30%, in Q1? And so that was great, because I was just pure long stock by then, but leveraged, That's the nice thing about it. So it's limited risk. The other nice thing about it is when, let's say that the print is negative, but your view doesn't fundamentally change. Like you still want to be long the stock. Well, you carry it to duration, or if it's if the front month is worthless, you just buy them back, right? And then trade into more of a vertical structure, right? So then you get kind of a doubly reduced cost in your vertical, and then you keep your exposure that way, although you've lost some of your deltas, So I do that a lot as well. It's kind of like it's more of like an efficiency thing, like just not, my view hasn't changed at all, and I want to keep the long deltas, like I have that on in Microsoft right now, actually, because I was long Microsoft into this whole market slide. So I actually have not a ratio calendar, but pure calendars, which are still just sitting there.
Nice.
Yeah. In fact, yeah. Now that I mention it, I wasn't paying any attention. I should actually buy back the short call in that structure. So, and that's what I'll do, right? Is that, and you can also roll them down, right? So you can, if your bias changes, right, you can turn around and roll down the short strike and invert your position and start to recoup some of that loss. As the market has told you which way it's going, So I do that more on indexes than in single names like this. I tend to just hold the tails in single names, because good things can happen to you, even in a zombie. When you have zombie calls laying around or zombie puts, like good things can happen to you. And so I just tend to inventory. They're worthless anyway, right? So you might as well keep them in inventory. It costs you more to trade out of them.
Right.
So like on a given day, if you look at my book, I actually have a tab in my account for zombies. I just keep them in there, and every now and then something happens, and the zombies get paid off. Some tail risk, some tail event hits in, and which is totally unpredictable, and okay, so yeah, I might do. I'll tell you what I do in chat tomorrow with TTD. I might do that ratio calendar we were just discussing. I might do your fly, or I might do like a broken vertical, like a fly like structure. I guess the difference in the way I would put it on normally is that, like, if I'm bullish, then I want to capture any bull move, not just, I want to have some long deltas. Like I don't want to be like, if it only prints up, I don't know, 11% or 10% or 9% or something, I still want that too, because I've decided that I have a bias. We got another one to talk about if you like. I think there's our mutual coverage, and that would be Datadog, right? Datadog.
Yeah.
the aptly named Datadog. It has been a dog. This thing, I'll tell you my target on it. And this is a stock that, like, Datadog's interesting because, number one, it's definitely best in class of what it does. And if you're running any kind of cloud infrastructure or any infrastructure at all, anything that has like we have a bunch of different microservices or different software components working together and an infrastructure and all of that, like, it is the premier way to, like, ingest that data, monitor it, to build monitoring, and to have support and analytics so that when something goes wrong, you can go find out what it is. So to me, it's still best of breed. there's no solution I think that's better in market than Datadog, and like you absolutely have to have it. Like if not it, then something like it, or you have to build your own. But if you're running 12-factor style app in AWS or Azure or whatever, or you're running your own infrastructure and you have lots of different, business middleware talking to your front end, so you absolutely need this to understand what's going on. So, and it's of course driven by utilization, and utilization always goes up. So it's a bit of a mystery also that they haven't firmly latched on to the specific needs of like AI clusters yet. I think that's coming. I read something from someone in product at Datadog, but they're making rumblings about it. Okay, but anyway, my target on it, 125 to 129. And in looking at its multiple, it's trading on the lower end of its multiple, and even on the consensus prints, like it's trading within the usually as low as it ever goes to its consensus print. So, or the consensus estimate, excuse me. So I think they probably are having a good quarter. I'm a little more nervous about it. In other words, my conviction is lower a little bit, just because of the previous 2 quarters, and we're kind of lackluster, right? So, but I think this is it's mid-year, right? So this is the point at which a lot of those new revenues will be realized, and so I think they're going to have a decent quarter. I think they're going to, at worst case, be on target. That's what I think. You also cover this one in a lot of detail, right?
I do, yeah. So some of the things I like about Datadog is it's really for me, Datadog is more a story about Splunk and how Cisco's acquisition of Splunk may not be working out for them as well as they had anticipated. There's some chatter that some larger Splunk accounts are moving, and I think part of that was my thesis behind Dynatrace and their ability to potentially win share there, and they reported and did well this morning. So I think that that's definitely an opportunity for Datadog to expand their business. I agree with you that they're not right. Right now the whole thing, once inferencing picks up, then Datadog will see some rebound. Like when traditional CPU compute work cycles pick up again, then you'll see Datadog get boosted. But for right now, because the incremental spend is happening on the AI side, and it's not being widely distributed in app formats yet that people are actually utilizing, there's just no increase in from the AI thesis to Datadog yet. And there's no reason to expect it until enterprises begin to release apps, their own internal apps, like AI apps, then it's a whole different story. But until then, it's not likely. One of the interesting things is recently, 2 weeks ago, there was the GitLab acquisition rumor, right? Where there was some concern that GitLab was shopping around for a buyer, and Datadog might potentially be one of them. I think generally speaking, that's seen as dilutive to earnings because GitLab's business model is so different from the observability stack. At the same time, just depends on what the vision behind such an acquisition would be. So I think it's too hard to tell, but it seems right now that acquisition would be a negative thing, and I think that's weighing a little on the stock. So one of the things I'll be looking for at the print tomorrow is what their commentary around that is. That's going to be a key thing. I don't have a position right now in Datadog. I did have a position, and then I exited it when I developed the Dynatrace thesis. because the for me, like the catalyst window for Datadog is really Q1 of 2025. And so, none of the trackers that outside of the Splunk thing, I'm not sure if there's really any I didn't see any like clear signals or nothing in my channel check that would have boosted that. If anything, all of the commentary that I received was that Datadog is really nice, it has all the bells and whistles, but if it's used a lot by startups and like some enterprise, but a lot of enterprise, if they get big enough and they need observability tools, they just end up making it themselves. They just end up developing their own internal tools. That was the feedback that I got from a group of like I don't want to say CIO level people, but like people that were high up in the stack and knew enough about these things. So that dynamic makes me feel like, okay, well, we're already in an environment where like sales are soft. None of my channel checks are implying that anything that's going to be better than expected. So I don't see any. I have nothing to disagree with the street on. The only things would be okay. There's this Splunk tailwind, which could be, yeah, customers could leave, but that again, my thesis was then that would benefit, a variety of other firms, including Dynatrace, which saw that. Uh, on the flip side, this GitLab overhang, I think, is going to be a concern. I mean, it could be a nothing burger, but still, I think it's something that's going to, weigh on the stock. Outside of that, I don't have any, different view. I typically, if so the way that I kind of like, I spoke about how like in the beginning of the quarter, I'll kind of like establish my expectations. There's really like two lenses that I do that from. The first one is like I'll look to see like, hey, what are the trends of estimate revisions for like the full year guide or for like the full year number? And I kind of want to be like the beta of my strategy is I'm long revisions. So I'm long positive revisions and I'm short negative revisions, and that's the portfolio that I want to carry. That's like the beta of my view. The alpha of the view is if I look at the estimates, do I disagree with the estimates? And is my disagreement with the estimate enough to actually drive like a decent, I have like a hurdle of say a 40% annualized return. So, so that's what's going to then dictate if I have a position. So I'll many times I'll have like a view. Yeah, I think the stock is looking good. Revisions are moving positive, but there was none of my research stuff resulted in anything that was different than the street or than the range of estimates on the street. I couldn't determine if there was a scenario that was more online. And then I think that for me just like this is like transparency for you guys. I cover 100 names, which is actually really hard. I probably don't do a great job of covering 100 names. I'd say about 50 names I cover pretty well, and then the other 50 names are like I'm trying. Um, and so by having that amount of names, at any given time, yeah, I can have 20 to 40 out of 100, right? I can have 20 to 40 views on what's going on. But typically, I'm looking at between 10 to 20 shorts, 10 to 20 longs. That's about it. Kind of going through the cycle. So having that coverage allows me to. Yeah, I don't want to have to. There's something called like the blue dot problem or like the purple dot problem, right? Where you just start to like see things in data. So like I don't want that to happen. I just want to like if I don't see, I just do these like regular intervals of research for companies. And if nothing that I'm pulling from is telling me that okay, there's something incremental that would shift my perspective, then I don't try to like dig in deeper. Now, after a company reports, that's a different story. So, like with Datadog, I don't have a position right now, but I will do a deep dive post-op, right? I'm gonna really like pay attention to the stuff that they say on the call. I'm gonna try to understand, is there anything that's being misunderstood here that I could take advantage of? And I'll do all of that work, tomorrow, and it takes 1 or 2 days, to kind of like get caught up on the name. But then through there, the coverage process is I just want to now stay in front of any new incremental information. And that typically doesn't change until major like release dates. So like quarters are big, investor days are big. Those are like the two primary times when companies will report like really big changes. Conferences are also important, or if there's some kind of a product announcement. So those are things that also require me to like dive in a little deeper on. Otherwise, I just try to like keep the idea of velocity up and cycle through the names. This is where like in the coverage process, and this is like the guys will know this, but it's like you have to initiate first. You have to like have that deep understanding of like, okay, let me just understand everything about the company before I even try to trade it. And then you can, be at the perspective where now you can kind of try to toggle for the incremental. So that's what's helped me kind of stay on top of these names. But I'm going to say like the majority of times I don't have a view on a name. Like I would say like more than 60% of the time I don't have a view on a name. And until something incremental shifts, right? And that's totally fine. If Datadog comes out tomorrow and they say, yeah, we don't have any plans to make a Gallup acquisition. We're not looking to make any acquisition in the near term. We're seeing Splunk, pick up. We're seeing customer appetite shift because we're seeing an increase in workloads. Maybe they tell us a signal that AI demand is picking up because maybe I'm sure there are some enterprises out there that already have AI apps that that their employees are using. So if they mention those things, oh yeah, then that is gonna create a huge change in my revision. So typically like the big informational events will really like set the stage, and then the market will price that. We'll get to the pricing, and if it gets to that pricing, then you're out of the name, right? But then through the quarter, the market can sometimes discount those scenarios, and then that's how you can tactically kind of trade around a name, even if there's no new information. So I'm talking about this because we had a conversation earlier in the chat talking about the different types of setups to trade, and I do want to. I sent them this presentation that AltaFox did a couple of years ago on like what drove multi-baggers. And maybe later this week, maybe Friday or early next week, we can have a call to go into that with more detail.
Oh yeah, can you share that with me? I'd love to take a look.
Yeah, I'll send it. Yeah, I'll send it over to you too.
Yeah, I did. I did some of that 10-bagger research myself not long ago. Last year maybe. I like to compare notes.
Yeah, it's not rocket science, but it's helpful if you are like how do you develop pattern recognition on like for fundamental theses, right? So it's like, yeah, I could tell you like ad nausea estimate revisions, right? Like I could say that ad nausea, like at the end of the day, one, it's either estimate revisions or it's two, market mispricing the estimate, right? So it's like one of these two things. It's either an estimate concern or it's a valuation concern. But it's helpful to see like, okay, how has this played out historically? You know, what drives estimate revisions? Am I going to see an estimate revision on any random day? No, you're never going to see like on any given day. There's not going to be a random estimate revision. Estimate revisions are primarily going to happen after informational events, like a major product release, right, or like a major announcement. Those are well telegraphed, so like if it's going to be an estimate revision, event. So, but this presentation is good because you can see like a bunch of different stocks that ultimately it boils down to estimate revisions and valuation. But it's good to see all the different paths that companies have taken. The more you get used to seeing like the setups, the easier it becomes. For example, like I'll often talk about like, okay, tracking a thesis. So like ultimately you could see it like a thesis could be like Apple is a really good example, right? An upgrade cycle. refresh cycle. We have a product refresh, which is going to lead to an increased refresh cycle this time versus the last period. So like that's number one. Why do I have that opinion? Well, they had a product announcement at the WWDC that was a software announcement, right? iOS 18. Okay, so that led me to have a view on what's going to happen with on the hardware side. The hardware catalyst is still going to come in either September, October when they actually announce the iPhone. But that's like this. That was the setup. It takes time for these to like feed into the market price because initially it's speculation about the success of that, right? But like every investor knew that was, or every like professional investor knows, okay, that is that's where you generate the idea, right? Like that's where the idea becomes a thing because of that. If you came to me yesterday and you said, "Oh, Apple, WWDC, like there's a new product," I was like, "Yeah, everyone has known about this from for 2 months now." So it's like you're behind the curve. Everyone tracking the stock knows the times where this is going to happen. So that's number one. You have to know like, okay, what drives that idea, right? And that's going to be like some information event. And then what's going to make it translate into an idea is you're going to then say, okay, well, what if this happens? What if what has refresh cycles look like historically? Okay, well, typically it's a 15 to 20% increase in volume unit shipments over a 2-year period. And for major refreshes, it's closer to a 40% increase. Okay, well, if we get a major refresh cycle, then we could see a 40% increase. And why would this be a major refresh cycle? Well, the last major refresh cycle, or like the biggest one, was like the iPhone 6, which is a whole new form factor. Would this be a big enough form factor? Well, is iOS 18 with Apple Intelligence, is that enough of a killer app to really shift things? I think so. And based on the commentary that or the research that I've done, with like like surveys that I've run, that seems to be kind of a view that's developing. Okay, so if this is going to drive a major refresh cycle, let me see what my estimate of unit shipments would be for the iPhone. Okay, I plug that number in, I get to a certain number. Oh, okay, this is the number. Then I look at consensus estimates and I see if there's a gap. Oh, there's a big gap. Okay, I like this trade. That's the setup, right? And then where's the market? Well, the market rally, the Apple stock rallied 10%. Yeah, but the 10% rally is so far from pricing in this refresh cycle. Stock is going to like double. So that tells me about what's the setup, my catalyst path, how I'm going to monetize this, right? What I need to watch for. But it all comes from like what triggers it is I'm looking at Apple every day. I know that every day, like I'm not expecting a revision or an information event every day. I know that there are specific times in the year that Apple releases information. There's specific. I'm only checking every day just in case something weird happens, like freaking Cupertino gets burned down or something, right?
Yeah.
So it's just like a risk management kind of a thing. But otherwise, like you have, and so for all of the companies that you cover, when I do my initiation process, I map this out. So I know like, okay, like what I have to pay attention to. And if you do this even on like 10 companies, that's probably the minimum amount of names that you need to do this process on. But if you do this with even 10 companies, like you'll always like you'll know like where are my theses, how are they all lining up. But you have to track it to you have to take information, so like non-structured information, like how does a WWDC event translate into iPhone unit shipments? That's hard. Okay, that's what we do as a hedge fund analyst. Like that's what we have to do. We have to take unstructured information, figure out how we would apply it to KPI. That's really hard. I don't expect some guy with a Vanguard account to know how to do that, right? That should be my edge, right? So it's like, okay. And then I have to then compare that to the street. So I have to say, well, what's the street looking at? I'm not a guy with a Schwab account doesn't have access to equity, research. So doesn't know what's already known in the market. So when we'll look at equity research, I now know like, okay, what's everyone else's hand, so to speak. So I know what their expectations are. Doesn't tell me which, it's just a range, right? Doesn't tell me who is more true, but now I know what the range is, so I can define the range. And then I can say, okay, well, if the market price went up by 15%, the market's now implying unit shipments of 250 next year. Like I could, like that mechanism, that transmission mechanism is very hard. Most people, I would say the vast majority of people don't know how to translate that, but we do. And that is why we can be precise about these things. It gives me confidence that like, oh yeah, the market's just underpricing this. So, I really like it. And then if I hear about, oh, Warren Buffett is carving off 50% of his stake, Apple is still going to be the biggest position in Berkshire Hathaway. He already telegraphed that he was going to cut the position because of tax purposes. And then he finally did it. It's a beautiful time to buy the stock because you had this structural supply, right? Like a price insensitive investor at that point, but already made a decision to exit the stock, right? Had offloaded 300 million shares. So, yeah, that's, you got to look at this from like a multi-faceted lens, but like that's what it boils down to. Now, in the short term, I'm not sure. I haven't sent you my. So what I did was I'll send you this spreadsheet that So I took my model and I slightly simplified it and I shared it with the team so they could see like how I both did the revenue build and the scenarios, and then also tied it down to like the probability.
Yeah, I need to see that because you showed me live, a couple of times, I think, like how you're modeling the probability scenarios for that and tying it back into the model. And, I kind of grokked it, but also like it's the kind of thing you need to see more than once, I guess, or I do anyway.
Yeah,
And
so
I
I'm just
rewatched the last video like 3 or 4 times before Tesla earnings. Just to let you know,
Nice.
James. Yeah,
Okay,
So
so
it's
this is
not just me then. Okay.
definitely
so
not just
this
you.
yeah. Okay, so this is a simplified model. I'll kind of go through what all is here. Why is it simplified? It's simplified because in this one, I'm just doing the revenue build and the income statement. Okay. So this top part is the revenue build, and the bottom part is the income statement. Income statement is always as reported, so it's always exactly how Apple does it. The revenue build is I scrape for the KPIs that Apple reports, and then I'll reverse engineer some things. Like for example, Apple since 2018 or whatever, they stopped reporting the iPhone shipments. Okay, but they give us the segment revenues, so I can back out the ASPs to get to an implied unit sales figure. Okay, so this is in my revenue build. Okay, so these are the unit sales for each of the product lines. Okay, and then these roll up into total sales. Okay, this is like the revenues. This is what it looks like in the quarter. Okay. This was the example that I gave, I think, before they reported, so this isn't updated. And then over here, I have a TAM analysis. So this looks at, like, for example, these are consensus shipment data. And so you can see what consensus shipments, looks like, and how, what it implied around iPhone unit shipments, through the period. This is the quarterly seasonalities. This is around unit shipments. I have unit sales seasonalities, right, for the quarters. This is the averages, and this is the 2-year upgrade cycle. So this is like the average of those 2 periods. This is the ASP averages. These are the segment averages. So I kind of have all that data here tracked. Okay, but this is just the model. So this is how we can I plug in a view about my iPhone, growth, and then that will change the unit sales. Okay. And then that will then roll up into revenue. So that's the purpose of a revenue build is so that we can play around with the different kind of components to understand, or to express our scenario. Let's go to the actual scenarios. So these are the actual scenarios. So I pretty much stripped down to 3 key scenarios. And this is after I scrubbed sell side. So I went through a bunch of sell side research reports and put this together. And so of there are the 3 distinct scenarios. Scenario A, which is like the bull case scenario, that's where you get an upgrade cycle driven by the iPhone. Similar install based refresh as the iPhone 6, so it's a 40% increase, and there's a services uplift. Scenario B, which is my base case, is better upgrade cycle, better growth from services. An upgrade, so the refresh would be closer to around, say, 25 to 30%. Services uplift is like marginal, maybe about a 5%. C is no upgrade bump. Services are positive, and there's a China headwind. Okay, because this was like the bear case that what I read through the different analysts they were citing. Okay, so then I go through over here and I extract the revenue estimates from their reports. I also extract their iPhone estimates from the reports, and that gets me to like a range of revenues and a range of EBITDA. And then I compare that with Visible Alpha's consensus estimates, okay, for units, unit growth, what the 2-year stack would look like, implied ASPs, iPhone sales. Okay, and then this is this is just like the revenues, and then the EBITDA based upon what those revenues are. That's like the midpoint of the margin was 35%, so I just stuck with that. This is VA's live, so this is like a plugin of, I got a Visible Alpha plugin, and it just grabs the data for me. These are the revisions. I can see how the revisions have changed through the period. So you can see that like in a 10-day period, 2024's estimates went up by 2%, 2025's went up by 3%, 26 went up by 5.6%. So that's pretty small relative to the actual deltas in revenues, right? So if you think about the deltas in revenue, like the unit growth deltas, like they're pretty big. Like the consensus delta for iPhone shipments is like 4.5%, whereas the bull case is almost 20%. Okay, so it's a pretty big delta, but again, the consensus estimates haven't moved up as much as those. So that's my view, 15% and 7% for unit growth. Okay, so these are the different scenarios that I've kind of lined out, and then my view, my scenario. I take my view and I plug it into this model. This is my revenue build. Okay, so I do my build, and then I model out what the income statement looks like, into the future. So this is the actual income statement. I model it out typically for the next like 5 to 10 years, depending. Obviously visibility is only over like the next 1 to 3 years, but it's good to have those longer term estimates anyway, because something may always come up. There may be a reason to do that. And then on my main page, this is where I just have all like the aggregate data, and then I do my multiples analysis. So for the multiple, this is the EV to sales, EV to EBITDA, and then PE. The red line is just what the average through the period looks like. So what I did was I did this since the last informational event. Remember, this was before earnings. So it was since the WWDC event to now. Okay, so that's the period. I just wanted to track to see what that looked like. And then what I did here was I said, okay, well, let's take a look to see this was the last information event. What has happened to the multiples? So I saw that the old multiple before the event was 7.2 times EV to sales. After the event, and then as of today, or since the data of this in this spreadsheet, it went up to 7.5%. So that was a change of 4.3%. So the metric, the estimate revision went up by 2.2%. So on an adjusted basis, the multiple expanded by that amount, and then I get to an implied sales figure. So that tells you that the sales number the market was implying, 4.57 billion in sales, given the move that we saw in the price. And then I track it for 2026 as well. because 2026 is the terminal year for iPhone shipments, like that's the year of the peak. That would be the peak iPhone shipment growth period. That's my quote unquote terminal year. So I'm going to price the stock on that multiple. If the terminal year was 2025, I would do it then. So the terminal year refers to like what is the bet over and when does the bet actually roll into the financials. So for example, if I thought that like say Microsoft was going to announce a product this quarter, when would the revenue from the product hit Microsoft? That's number one. But then two, when when would that new product reach its like sustainable growth path? That might take 1 or 2 years to get to that level. That's really what the bet is. Okay, what's the growth going to be? What's the level that it's going to settle at? In that, once this new product, comes out and is successful. So for me, that's the 2 year mark. That's fiscal year 26. So did this analysis. I could see what the range of the implied units are. I compare them against my view, and then I use that to then come up with the price analysis. So this is my actual stock price analysis. So this is this was the stock price at the time. I think it's I think this is live. Yeah, this is live. So this was today. This is my price target based upon my view of sales, EBITDA, and then the multiple that I think that we're going to track. So that's my price target. And then this is target analysis. So what I do here is I say, okay, well, this is what the stock is trading on the current estimate. Okay, so this is the current estimate. You see, my estimate is 179. The market or the consensus estimate is 155.9, 155.9. Okay, so on 155.9, the market is trading, Apple on a 20 times, EV EBITDA. Okay, so if the market were to price, so what is my my estimate using the market price? That's a 17 and a half times. So I'm cheap relative to so Apple is then trading cheap relative to consensus estimates. Or on the multiple, it's actually much cheaper than the market implies. So this gives you what my metric implied upside is, and then what I do is so now I have like my different scenarios, and so these will track with the different scenarios that I have in mind. And then what I'll do here is I'll say, and so this is how I kind of manage incremental information. So say right now, like when I first did this, like these are the odds that I had set. And then say tomorrow, Tim Cook comes out and he says, oh guys, actually we're canceling our OpenAI integration. We're going to use some like really basic, janky, AI, tool. So in that case, now I might say, oh, well, this is now less of this shifts my distributions of what I think is going to happen. I would bring this maybe down, and I get to like the fair value, what my fair value is. This is like my near term price target. This is like where I think the stock should price right now at this moment. My price target is where I think the stock should price if the market reflects my view of sales and EBITDA. And there can be there's a time dimension to the price target, which is when will the market know that it should be at these levels? And the market will know, when we have more information about what the new iPhone is, when we have more information about the production numbers that Apple, is giving to their, down the value chain, to their manufacturers, right? So there's a lot of incremental information that will help the market get here. My view is that we're actually going to get to this point by next quarter. Okay, and we're going to get to it because we're going to get the iPhone, announcement event, which is going to be either next month or in October. We're also then going to have the earnings of Apple suppliers, in November, and that is going to, I think, show that incremental, information. And then we're going to, Apple's, results too. And so that's roughly about the time when I think that the market will begin to price in my view of sales and of EBITDA. When the market prices in my view, then I don't have a trade anymore. So I'm done at that point. So this is how I approach it. But the fair value is every day I might update it and say, okay, well, this is based upon something new or incremental. I might shift my probabilities, because of that. So this is how, this roughly tracks. Yeah, I'll send you a copy of this though. It may still have some Bloomberg and Visible Alpha links, but I try to make it as unheavy as like as light as possible.
Yeah, I would appreciate that just so I can step through it, and I can always go in and plug in values manually where needed, and just sort of get an understanding of how it works. It's interesting that sometimes you and I get to the same place, and I'm coming from a markedly simpler, world of time series and raw stats kind of stuff. But sometimes we get in the same zone. It's interesting. It's interesting with with a little bit of video knowledge of how things unfold.
It might be a good trade.
Yeah. Yeah. I can't wait to be good at this. I can't wait to be good at that. That's what I'm trying to say.
I think a good takeaway though is that the way that I see that kind of analysis that we do is it's more of a filtration technique, right? It's like this is the due diligence we do because broadly speaking, I think technology companies are going to continue to grow. So my bias is buy and hold, QQQ or buy and hold NASDAQ and let it rip, right?
Yeah.
So then it's like, okay, well, there's 100, NASDAQ 100, right? There's 100 names there. Do I want to be in every one of those names? Who do I think is going to outperform or underperform, right? And so as we start to whittle away, you need additional information, for each of the companies. So that's kind of how I see, how this process works. But yeah, I don't. Yeah, I believe it. I think that there's definitely a lot of overlap. You'll see that I think actually what you'll find is because you're someone that you're familiar with momentum and these kind of trading styles. I think you'll find this super helpful because a lot of people will wait for price to tell them what's going to happen. But the nice thing about when you go through and cover things, from a fundamental standpoint is what's going to drive the price. So you want to be long momentum when there's a fundamental reason for momentum to persist. Exactly. And as soon as the fundamentals flip, oh, okay, I need to exit my momentum. And momentum might overhang, by the way, because there's a lot of people that just follow the time series, right? And then they get that Minsky moment, the Wile E. Coyote moment,
yeah.
and they get rug pulled, right? So,
yeah.
It's definitely, one of those things.
Yeah, and it's all net additive to me because a lot of what I'm doing is coming at this from a a technological evolution angle. So fundamentally, I'm looking at some technology trend that I think is going to drive the earnings of this company in particular because they have a pole position, with a firm technological advantage, right? Or they have ecosystem effects that are insurmountable, like as in the case of Apple, right? And when they do something that's innovative, the ecosystem effect, just does the rest of the work for them, right? So companies like the natural monopolies like Apple and Amazon and Google, they have the luxury of screwing up as much as they want almost, because their ecosystems are so strong. But I look at these these horizontal trends, you could take LLMs for example because that's the hot case, right? And then I look at them in a lot of detail, I'll give you an example. So the fundamental problem with LLMs, apart from the need to keep scaling their model size, is that they hallucinate, right? And to use them in a business context, they have to be grounded, meaning that they have to use a technique like RAG in order to constrain the output in a way that is rooted in a source of truth. And when you decompose that stack, okay, like if presuppose that RAG is necessary for the enterprise, and it is, what is the best way to build RAG right now? Like what from what companies would you buy what products to build a RAG stack today, and put it into production, right? So that leads you to the breadcrumb trail of companies like Elasticsearch and other tools like LangChain, and the entire ecosystem to pick and pull from. And then that leads you to the companies that have to reconfigure their value chains, to service those, right? And the companies that do that quickly inevitably capture market share. So I come at it from a totally different that's all fundamental, right? It's all fundamental, but it's thematic, And then
we would describe that as you're looking for companies that are levered to a theme.
That's right. That's right.
But so what I would say is that okay, so let's go down this hypothetical, right?
Yeah.
NVIDIA and AMD. Okay. They both make GPUs. Okay. So if you were to start off and you were to say, oh, I want to just go buy the companies that are going to win off this LLM thing, let me go buy these GPU makers. So you go and you buy NVIDIA and you buy AMD, right? My point is that well, it's even better if you can go long and short within this theme, right? Like who is actually going to benefit and then who is not actually going to benefit? Who's like a fad or a fraud in here, right?
Totally. Yeah, 100%. Yeah, 100%.
And that's where it's like the thematic aspect is really helpful because that there's something called cellular stratification. there's this whole argument about how do you whittle down the list of opportunities. And so there's a variety of different processes. Some people say you should never, and right, that's why there was a thing 2 or 3 years ago, there was a theme in asset management where every long only or every single manager had a book of over 100 names they were in, which is crazy. They just had massive books. And the thinking behind it was that you actually should look at the entire sample. Whenever you restrict or limit the sample, you end up losing information. The problem is, well, then you also dilute returns, right? So what I think is actually the sweet spot is high conviction sort of, investing where you're working with this limited subset of names. But the thing that was that ultimately it's okay, well, even the tech sector in the United States, there's 800 companies at the minimum that fall under tech, right? So it's how do you can't sort through 800. How do you quickly figure out where you want to invest in? So one way is, you could do a thematic shrinking. Personally, and this is I think what you have started to do too, which is there's another approach which is called the coverage model. And the coverage model is to say, I'm going to look at these companies independently of any sort of theme. I'm just going to try to understand the market map. Okay, and organize companies along their verticals, like the products and services that they compete with to provide. And then from there on this fixed set of companies, I'll then understand the themes. So it's what starts the thematic process? You do that first or after. The problem is if you and the thing is that you have always kind of covered tech. So I think for you it might have just been natural because you are already covering these companies. But imagine that you were someone that didn't have a background in any particular sector. There's so many themes, right? There's you got robotics and then you have 5G, IoT, right? Which theme do you invest in? It becomes super confusing I mean, trust me, having sat in more of a generalist role before, where you're a PM and you're working with different investment committee members and no one has a clue about these themes. You just know there are different themes out there, they want to invest in them, right? So it's it's very hard, I think, for people to figure out how do you assess these themes. So personally, I think that the better style is fix your coverage, and then when you understand the themes that impact your coverage, the better. And ideally, how then do you determine your coverage? Should be companies that you would enjoy covering because it's to some degree there's a lot of boring work involved too. So this needs to be the thing that if you're going to pick up the newspaper, this is the section that you would read anyway, right?
Yeah, and I'm totally coming at it from the thematic angle. Like I have my entire research tree organized by theme, and and you're right. It's because I'm immersed in those themes, right? But it's also because like there's something special about like technology evolution and how technologies diffuse through society. You know, in a capitalist, quasi-capitalist, system, and this is actually observed, I think, first by a philosopher, by Jacques Ellul, which is that any given technology diffuses itself maximally into every place it possibly can in a capitalist system at the at the equilibrium value. And then you had others like Everett Rogers come along and talk about. I'm sure you've heard the fusion of innovation, crossing the chasm, and all that.
Right.
But like, but it wasn't until I met this guy Simon Wardley who kind of overlaid an observation on top of the Everett Rogers S-curve thing. Because when you ask the question, like, well, there's all these themes, there's always something cropping up in tech, right? That's like thematic. So, I mean, what do you invest in? How do you know what to pay attention to, as opposed to like, science project? And so, I'll share my screen if you can see it. This is a brief, and we use this in venture investing. So this is like, because venture investing is really hard because there's nothing to look at. I mean, there's no, quite often there's no comps, there's no nothing, to look at in terms of data, like for like how this company's going to do financially. And so it's essentially all thematic plus other really qualitative things. Like, is this a person who can execute and will continue to like work themselves to death against, when all evidence tells them to stop, Can you see this? Can you see this?
Yeah.
Okay. So this is on my blog, and I wrote this back in February about, NVIDIA's strategic problem, to try to like, just an example of like how to call out a problem that already exists that no one is paying attention to.
Did you AI generate that, the picture?
Yeah, this is AI generated.
That's cool.
Yeah, and this is an example of grounding, by the way. Like I was talking, like, to get a picture of him, I had to provide the model with many examples of what he actually looks like to get it, to get it to actually look like him, and to have like circuits in the background and stuff. Yeah. So this is kind of like all the art on my website is AI generated, but it's all grounded. It's a model I've been working with to try to be able to generate a consistent output, that looks looks the same way. But anyway, you can check this out, and like here's a blow up of the Wardley curve. So in the background, this this S curve, this blue line, that's like the Everett Rogers diffusion of innovation stuff, right? Like in the beginning you have like experimentation and early adopters, and then there's a chasm between mass market adoption and early adopters, and most technologies die in that hole. That was the whole Everett Rogers thing, popularized by the book Crossing the Chasm. Okay, but Wardley's insight, and he gave this to me for free, and he gives it to everyone for free. So I turn right around and I show people how to use it because I think it's a great gift. Is that as technologies diffuse, as they become more and more ubiquitous, and they become more and more certain, meaning they're more componentized, more standardized, there's supply chain is mature, et cetera, et cetera, et cetera. Well, the companies along the curve tend to evolve their competition, like how they compete with each other, how they sell to the marketplace. And so in the beginning days, in the genesis stage, like a technology doesn't even have a use case. Like it's a science project, basically. It's pure R&D, right? And you can lump tons of pharmaceuticals in there, all kinds of stuff, everything from Benjamin Franklin flying a kite in a thunderstorm with a key, to pharma research kind of goes in that bucket. And then the first commercial activity you see out of Genesis, they tend to be custom built, custom built anything, custom built drugs in pharma, custom built, really large scale machinery, so like every little, and you kind of see this now with like even some of the newer, AI rigs are like, everything is custom inside the whole system. Or, quantum computers is a really good example of like the totally custom process, that Google applied and IBM applied to build their quantum computers, right? It's not industrialized in any way. It may have industrial components in it, but everything is a custom fit. And then you get this, healthy product ecosystem where instead of being custom, the components become componentized. And then, lots of competitors plug into the market to supply components, right? And then many competitors emerge, many substitutes emerge. it's actually a pretty healthy, we call it a time of peace, because there's lots of companies all competing and making money. But somewhere in here, you cross the line into service towards commodity utility, and that's a time of war. And so we've seen this very recently in like computing, as computing went from everyone selling servers and software and network switches and data center pieces and bits and parts to cloud computing, which is utility. Right. So, and the gravity, like the event horizon of utility is insurmountable economically. You had all these companies trying to compete against Amazon with whatever technology, and it just totally didn't matter because, you know, there was like a black hole up in the upper right of this graph, and Amazon did everything they did for free and just sucked everyone into the, you know, paying for their infrastructure. And they're still doing that today. In fact, they're about to do it in AI. It's like a complete repeat of history. Okay, so once you have this kind of like framework in mind, you can map any technology, any trend at all. You can map like, okay, is this thing in market? If it is in market, how is it competing? If it is competing, is it competing as a substitute, a niche? Is it competing as a new, like, profound technological wonder, or is it just, you know, is it just there because people are buying it? You know, because like there is, it's like, you know, when something's a total commodity product or service, like, you know, there are painters on Yelp because people buy painting services. Like it's just, you know, there's no reason, there's no, you know, there's no like trend, right? Okay, but you can look at any company like that too. Like you can, in the macro, this is like macro analysis of the trends, and you can dissect a company like NVIDIA. I'm a very visual person, right? So I like graphs and charts and stuff, but NVIDIA, you know, innovated back here in the Genesis stage into GPUs, and then those ran up the curve right into mass adoption where we are now. Okay, the problem is that their competitors are already also working on next gen stuff, right? And their stuff will also move up the curve, and that will increase the competition in that segment. So NVIDIA knows this, of course, right? Because that's what happens to you if you're a chip maker. And that's why you see, by the way, these like there's kind of like 10 to 14-year cycles in semis. You know, someone comes up with a revolutionary new technique or fabrication technique or something that reduces cost or increases performance, and they get like a 10-year grace period, you know, because everyone else has to catch up, and then they go to hell, right? So NVIDIA knows this. I mean, Jensen's no dummy. So what they're doing is they're trying to sell, paradoxically, they're trying to sell GPUs to the systems vendors. That's Dell, HPE, Lenovo, you know, et cetera. It's like all the guys building systems and the hyperscalers on the upper right of this graph. At the same time, they're introducing systems to market that compete with their own customers, right? So they're introducing pre-integrated systems like NVIDIA clusters that compete against Dell, that compete against HP, because that's a pretty uncomfortable thing to do. And what it does is it makes the competitor go solution seeking pretty fast, right? So I assure you, you know, Dell, HP, everyone else is buddy with Intel, AMD, every other chip manufacturer trying to bring the next gen substitutes up the curve into market as fast as possible, because NVIDIA is out there competing at an impossible price point, right? And they're driving up the cost of all these systems, and that's ultimately a drag, and it's an inefficiency, right, in all those businesses. At the same time, NVIDIA has deployed a software layer to try to disintermediate software developers from the cloud APIs. Okay, this NVIDIA enterprise play, and they're monetizing, you know, they're selling the systems and the software hand in hand. Okay, and they're already at like $1.1 billion of revenue in software sales, and that's probably their biggest, one of the biggest sleepers inside of NVIDIA revenue, is that could blow up really quick into like $3 billion or $4 billion or $5 billion of revenue. You know, and the last is that they're partnering with certain data center companies to sell NVIDIA clusters like as a cloud service. So this is one company trying to do all this against, you know, you guys have heard maybe like blue ocean strategy. Well, there's no blue oceans in the world. They're all red. They're all seas of red blood. And so they're competing in 4 or 5 different red oceans, not against, like in the upper side of this, they're not competing against like sluggish companies. They're competing against the best, most efficient companies in the world at bringing new technology to market. And so the response of the hyperscalers, of course, is to develop their own chipsets, you know, to do everything vertically integrated, to wring out every penny of margin that they can in their cloud services. And let me tell you, the stickiness of that, together with the rest of the platform, is an insurmountable barrier. Is an insurmountable barrier. There's zero chance that NVIDIA's software strategy and platform strategy will succeed. 0.0. It will not work. Microsoft and Google and in particular Amazon will obviate that so fast it will stun them. How quickly that the developer ecosystem shifts, back into AWS tools, etc. So that leaves it. You can what did Schwarzenegger say? Human now, believe me later. That's how that's going to work out. Which brings us back to the systems vendors, who are of course sourcing alternatives. Okay, so I'm actually quite pessimistic. Not this year. I mean, they sold everything that they can possibly build this year and part of next year, right? But I'm quite pessimistic on more like the 1 to 2 year curve from now for NVIDIA, because I feel that the competitive dynamics are insurmountable. Basically, they won't be able to sustain a competitive technological advantage in chips, right? And they can't move up the stack into software. So they will get relegated once again to being a component supplier to the hyperscalers. Okay, so all that, to my view, all that premium will come out. So like I'm just waiting. I'm very happy to get long NVIDIA right now when their earnings are cranking, sales are cranking. I think it's a great long into their earnings still, and I'll be picking it up shortly. I'm not in it right now. But at this price, I quite like it. And I don't think that changes anytime soon. But like, I'm waiting for the moment, when I see evidence that, adoption of stuff like AWS Bedrock and, similar solutions in the hyperscalers are becoming concrete, like cementing, basically. And then that bodes very poorly for this strategy. So if I was running strategy at NVIDIA, which is ostensibly probably what I could be doing, I'd be guiding them away from this and more like, deploying strategic open source. They were doing some of that too. And then we could go way in the weeds on this on like, CUDA as a technology stack and like alternatives to that. But anyway, that's the way I see it playing out. And that's all, everything I just gave you is like thematic and macro, right? So I'm just tying this together with the.
I would actually say that you narrowed it down to this is NVIDIA's strategic operating plan. So that's a pretty idio view. Because yeah. And if you did this with like AMD and Intel, like then you would actually have the full dimension and then know how, you could develop a view of what companies you thought had a better posture, in this environment.
Yeah, and I did. I mean, I was short Intel, for a year. And it's just funny, because it's like in chess, right? It's like you actually realize that you lost the game like 14 moves ago. Like when you're competing against a pro, right? Like who's like a master level player, you realize, you think that you're competing, right? And then you get to checkmate and realize, shit, I took that pawn like 14 moves ago. That's why I lost the whole match. And that's like that's what happens in the like there used to be a game in the 80s called Cubert, where you'd fall down a graph of blocks. That's what happens in these game states, right? Like Intel lost this entire war like 6 years ago, 7 years ago, 10 years ago, actually, like a long time ago. And they've gone from being like a premier venture capital investor to like a struggling, again, their time in the sun, their time in the sun waned. And I'll even tell you, like, the two companies, the real Genesis stuff right now is like things like neuromorphics, right? And like Sam Altman has started a chip company in neuromorphics. Like that's how nascent it is. But IBM and Intel have been working on neuromorphics for the better part of like 15 years. That doesn't mean that they're going to win, but it's hard science stuff, right? It's not something that easy to turn up as a startup or like as an initiative, even if you have a lot of money like NVIDIA. Like it just takes time. As we say, probably not allowed to say this anymore, but like 9 women can't make a baby in a month, right? So resources are not enough. Right. There's hard research and building and system, experimentation, integration shit that has to happen to get a technology off the ground. So they definitely have a leg up with. And there's even there's neuromorphic companies out there that claim to be neuromorphic, because it was, it was again, as a theme, it was something sexy to say. But if you want to get to like the hype everyone's talking about, like AGI and the super intelligence, it's absolutely not going to happen with computers as we know them today. Like, it will not happen with glorified spreadsheets becoming self-aware. That is not happening. Just flat out. It's all hype,
So I think that like I think that one of the like the bull case for Nvidia is not like an AGI contingent thing. I think that, and I would say this is actually like morphing into the base case, which is that it's simply that this LLM stack is getting embedded in multiple layers across software and across like all the little things that people do.
Yes.
So
Yes.
because it's so useful in all these like small ways, not like a major way, but like in small ways. And so just like, for example, storing, taking your files and storing them from your physical, file cabinet into the cloud, right? Didn't dramatically shift your productivity, but what did it do? It required a massive amount of compute resources to be developed and deployed. We had to build all these new data centers for AWS and Azure and GCP. So similarly, that's what's happening in the LLM phase, where the amount of GPU clusters that we currently have deployed is just not enough to do like the basic stuff. Like, I'll give you a good example. Okay, Meta has over 1 billion daily average users. Okay, they have embedded AI into Meta and into WhatsApp or
Everything,
into
yeah,
Facebook
yeah,
and all these things,
yeah,
right?
yeah.
And so it's not even that like the use is like an obvious one where like, oh, I'm asking for recipes or blah blah blah. It's the small stuff like even post recommendations or like what I'm seeing in my feed. Those all require this new tech stack of using GPU clusters instead of your traditional CPU compute, right? And so like how many simultaneous users can one GPU, manage? Maybe like 10. So you're going to need hundreds of millions of GPUs, right, deployed to manage the workloads. To have uptime, 99.999% uptime, you're going to need to have a massive amount of clusters that are up and running. We're so far from that. Right? We're just barely like scratching the surface of this right now. We're gonna need like
That's right.
roughly around like $1 to $2 trillion. I think it's closer to $2 trillion worth of capex into building these AI factories, and then we'll be at a point where there's probably not so much more upside after that. It's gonna be just like maintenance capex. But the thing is that in the first part of this drive, right, we're in still this like adoption phase. So this is how it translates fundamentally. Okay, right now, so I'm gonna take this is the toolkit of an analyst, right? I took your unstructured data, right? Your graphic. What does this actually mean for the company? Well, I'll tell you what it means. It means that their operating margins are too high. They're over earning right now this period. And those operating margins, they went from like 30%, 35%, they're at 66%. Those are gonna move back down to the 35% range. When is that gonna happen? It's gonna happen when there's enough competition from AMD and Intel that you're gonna get pricing pressure on the GPU chips. Okay. So when is that part of the cycle going to hit? Is it gonna hit this year, next year, the year after? That is very sensitive to hyperscale capex trends. Because if those guys are still increasing the amount of data centers that they're building, then the TAM is expanding for NVIDIA. And right now, NVIDIA has a 98% market share. So it's
we get to exactly the same place because the hyperscalers, all of them, Meta, Tesla, Amazon, they're all committing orders, right? And they're also locking up supply from each other. Let's not underestimate, like, they're deploying their capital strategically to block competitors who need access to these components to go compete with them, right? So
right.
some of this buying of inventory is like just to slow down the other guys. It's kind of amazing that when you got a balance sheet that big, you could do it, right?
You could do that, yeah.
You could do it. So Amazon and Meta in particular And I think soon, I mean, this is pure speculation on that. If I say the words Tesla, that's just pure speculation. But like Google and Amazon, you know, they have chips, right? And they have the ability to make more, a lot more. And they have new techniques that they bring in that are, you know, coming out of Genesis. And in their case, they go straight from Genesis into the utility. You know, so just, you know, there's no adoption curve in market. Like they don't take it to market in the mid-market, like in that product ecosystem zone. That doesn't happen. It goes into cloud services, goes into the infrastructure, into the CapEx. So we can watch very closely the commitments that they make and time it very well. You know, because they will stop making noise that they are taking down supply. And that'll be your canary in the coal mine